taxation.
Yes, so if we have the question with you, just confirm. Just confirm. Yes, are you there? August 2023, question number 1. August 2023, question number 1. Okay, so what are we told as far as that question is concerned? What are we told? What are we told? Yes, so the question reads, H Limited, a public limited entity, had exercised a significant influence over S Limited, another public limited entity, for many years before obtaining control. H Limited acquired 40% ordinary shareholding in S on 1st of April 2013 for a cash consideration of 2,500 million when the retained earnings of S Limited stood at 360 million. So, and then you're told the draft statement of financial position of the two companies as at 31st of March 2023 are presented below. So we're given the statement of financial position of H and S. So we have the non-current asset, which comprises of PP, investment in S, and then we have the current asset comprising of inventory, receivables, cash, and cash equivalent. Then we have equity down there, which comprises of ordinary share capital, retained earnings, total equity. Then we have the non-current liabilities, which include 10% roll notes. Then we have current liabilities comprising of trade payables and trade and the current tax. Then we have additional information number 1 all the way to note number 8. So what are we required to do in our question? So Roman 1, we are required to do what? To determine the equity accounted value of the investment in S Limited on 31st of March 2019. So then we are required to calculate the goodwill arising on acquisition of the acquisition of S Limited at 1st of April 2019. And part C, we are required to prepare the consolidated statement of financial position of H Group as at 31st of March 2023. So basically, this is a question for piecemeal acquisition as per the information which are given in paragraph 1. And therefore, the first thing we need to do here is automatically to come up with a group structure. Take into account this is a question for group accounts. We need to have the group structure here, the group structure. Now, if you go back to the information which we have in paragraph 1, let's go back to the information in paragraph 1. So specifically sentence number 2. Sentence number 2, we are told H Limited acquired 40% equity shareholding in S Limited on 1st of April 2013 for a cash consideration of 2,500 million when the retained earnings of S stood at 360. So basically, we are told in that point that H Limited had acquired 40% shareholding in the company which is called S Limited. On which date? On 1st of April 2013. 1st of April 2013. So, and therefore you can see that initially H Limited was a parent and then S Limited was an associate. Was what? An associate. Then let's go to the information we have in the additional information number 1. Additional information number 1, we see what you're told. We are told H Limited acquired a further 30% interest in S on 1st of April 2019 for a cash consideration of 2,200. That is 2,200 million. So we are told this company acquired a further 30% shareholding on which date? 1st of April 2019 for a cash consideration of 2,200 million. So basically what that means is that this company here, that is H Limited, by the end of the day, it was able to acquire the control, because you can see that H Limited will be having a total shareholding in S equal to what? Equal to 70%. So therefore, this is basically the date when the parent company acquired control over who? Over S Limited. And therefore, you have said when computing the goodwill, we compute the goodwill on that date. On the date the parent company acquired what? The control. So I think in our case, we already have the group structure. And I think if you go through the other information, note number 2, note number 3, 4, 5, 6, 7, and 8, you'll be able to see that this company here had not invested or did not invest in any other company. So I think having that, we can go through the additional information. We see whether there are some workings which are required. So note number 1, what are we told? Note number 1. In note number 1, you're told H Limited acquired a further 30% interest in S Limited on 1st of April 2019 for a cash amount of 22. And then you're told at that date, the retained earnings of S amounted to 860, and the fair value of the previously held 40% interest in S Limited was 3,000 million. So in that case, you can see we are given the amount which the parent company paid in acquiring 30% shareholding, and also we are given the fair value of the original investment. The original investment is what? 40%. So that information, we are going to use it in the computation of goodwill as required in part B of that question. In computing the goodwill, we need to have the cost of additional investment, how much amount was paid in acquiring 30% shareholding, and what was the fair value of the original investment. The original investment is what? 40%. So then let's move to note number 2, and we see what you're told. And we are told at that time of achieving the controlling interest, this is the date the parent company acquired the controlling interest. We are told the fair value of its identifiable net assets approximated the carrying amount with an exception of the following items. In other terms, what you are told is that on this date, when the parent company acquired the control, when this company became a subsidiary, this company revalued assets. Revalued what? Asset. In our case, in note number 2, there are 2 assets which were revalued. In point 1, we are told an item of plant whose fair value exceeded its carrying amount by 150 million. We are told an item of plant whose fair value exceeded its carrying amount by 150 million. On 1st of April 2019, this item of plant had a remaining economic useful life of 6 years. So basically, this is what? This is what we refer as the fair value adjustment. The fair value adjustment. Remember, you say the fair value adjustment. This is basically the valuation of assets by who? By the subsidiary. So what we need to do, therefore, is basically to make 2 adjustments. So we refer to that as the fair value adjustment. The fair value adjustment, or the fair value exercise by S Limited. So in that point number 2, that is point 1 of point 2, we are told the item which was revalued is a plant. And actually, the first thing we need to do here is to determine the revaluation gain. And then from there, we compute the depreciation what? Other charge. Sasa? Yes. So we are told that the fair value exceeded the carrying amount. The fair value was more than carrying amount with an amount of how much? With an amount of 150 million. Now this 150 million, remember, it was not accounted for. So therefore, taking into account it was not accounted for, number one, we will add this to the group PPE. Number two, this one is a pre-acquisition revaluation gain, and therefore this one would be used in the computation of goodwill. When computing the goodwill arising on acquisition of this is one of the pre-acquisition reserve. Number two, we need to compute the depreciation other charge. The depreciation other charge, and basically that depreciation other charge is by S Limited. By S Limited. I hope you can be able to recall the formula which we use here. We take the revaluation gain, that is the formula which we use, divided by the remaining useful life of the asset times the proportion of time. The proportion of time. The proportion of time is the time difference between the date of acquisition and the date of consolidation. In this case, when we talk about the date of acquisition, is basically the date when the parent company acquired the control. Not this date, but the date when the parent company acquired the control. Because in fact, the assets were revalued on this date, not on that date, on this date. Sasa? Yes. So therefore, the revaluation gain in our case is 150 million. We divide that with the remaining useful life, which are basically 6 years, times the proportion of time. So how many, I think in our case, we have some few months here, because we need to identify the number of months, or basically the number of years we have between these two dates. That is this date here, which we are referring to as the date of acquisition and the date of consolidation. The date of consolidation is the date we are required to prepare the group accounts. So if you go to the requirement, which is our date of consolidation in our requirement, the date of consolidation. The date of consolidation. Who can see that date? The date of consolidation. Yes, the date of consolidation is 31st of March 2019. 31st of March 2019. 31st of March 2019. 31st, oh, sorry, not 2019, sorry. Yeah. Yes, should be 2023. Sorry for that. Should be 2023. Should be 2023. Yes. Should be 2023. Yes. Let me get it clear before we move. Yes. So if we go to note number 1, our parent company acquired additional investment on that date, which is correct. And then the date we are required to prepare the group accounts is per note number as per requirement C. Yes. So it should be 31st of March 2023. Yes, actually here we don't have months, but basically we have a number of years. How many years do we have here? How many years do we have here? The first year automatically added 31st of March 2020, 2020, 2021, 2022, 2023. 1, 2, 3, 4. How many years? Do we have 4 or 5 years? Fred is saying we have 5 years. Do we have 4 or 5 years between those two dates? How many years do we have? We have 4, because we have said that the first year did 2020, 2021, 2022, 2023. Yes, we have 4 years. So meaning that we are computing depreciation other charge for how many years? For 4 years. So let's work out this. Let's work out this. Let's work out this. So this one will give us 100. Now this 100, number 1, This one will be deducted from the group PP. This one will be deducted from the group PP. And number 2, this one will also be deducted from the retained earnings of S Limited. We also deduct that from the retained earnings of S Limited. But the key adjustment is this one, because you see in most of these questions for group account, by the end of the day, you don't have to compute the group retained earnings. And actually, this one we are going to use it in computing the group retained earnings. Let's move to point 2 of note 2. And we are told on 1st of April 2019, the same date, the directors of H Limited identified that S Limited had internally generated database of customers who had the potential of purchasing their product for identifiable period of time. So although there were no contractual or legal rights associated with the database, a professional expert estimated that a competitor of S Limited would be prepared to pay 90 million for this database. Now, even before you move to the last point, if you have a database of customers, customers and who you can be able to sell, this database to the competitors. You recognize this as what? In your books of account. What is this in your books of account? This database of customers you can be able to sell to your competitors, or you can be able to use. In terms of advertising, you can be able to sell some messages to these customers, and basically they'll come and buy. Some of them, not all of them automatically. Yes. Basically this one is recognized. This one is supposed to be recognized as an intangible asset. This one is supposed to be recognized as what? As an intangible asset. You recognize this as what? As an intangible asset. Sasa? Yes. So therefore, this database of customers will be recognized as a database, of which you can, what you're told in the last point, we are told that S Limited had not recognized the database as an asset in its individual financial statement. So basically, this is an intangible asset, and you can see its value was established on the date this company was acquired. So therefore, what we need to do in relation to that point, we have said that that database of customers is an intangible asset, and we are told the value for that intangible asset is how much? 90 million. So this one will be recognized within the consolidated statement of financial position as an intangible asset. And number 2, because it was revalued, so then we also recognize this as a pre-acquisition revaluation gain, because you can see this is a database which existed, but its value had not been established. It was revalued. It was what? Revalued. Sasa? Yes. It was revalued. The other thing you also need to determine as far as this is concerned, in case you're told this intangible asset has a definite life. Has a definite what? A definite life, you need to compute its amortization, because in such a case, if you're told it has definite life, you must be given the expected useful life. Now, there is something which you're told in that point, that this database can be able to buy from this business for an indefinite period of time. So meaning that in this case, we don't have to amortize this. We don't have to do what? To amortize this. But if you are told that these customers are likely to buy from this company for a definite period of time, will be given the estimated life, you have to do what? You have to determine the amortization. Sasa? Yes, but in this case, no amortization. We just recognize that as an asset. And number 2, because it was revalued on the date of acquisition, we do what? We recognize it as a pre-acquisition revaluation gain. So someone is asking, where was 90 million? Now, basically, if you read on that point, what you are told, we are told these are database which existed in the company. And actually, on the date H Limited acquired S, that is the moment the directors of this company were able to determine the value of that database of customers. That basically what you're told. If you read that point very well, that's what you're told, that the directors of H Limited identified that S Limited had internally generated database of customers. So means that the directors of S Limited, after acquiring this, that is the moment they were able to establish there was this database, which you are saying, then it needs to be recognized as what? As an asset. Was this database acquired from another company? No, it was an internally generated. Internally generated. So if it was internally generated, it was revalued. Sasa, yes, you come up with a value for that database of customer. You have done what? You have developed. So you are not acquiring that. If it was acquired, maybe that one should be credited in the bank. Sasa, yes, yes, but it was revalued. So that is basically the treatment for that. So then we are done with that. I hope that is clear. I hope that is clear. So let's move to point number 3. In point number 3, we are told the group policy is to measure the non-controlling interest at their proportionate share of the net asset in the subsidiary at the date of acquisition. Automatically, this point is to help you to know which method you're going to use in the computation of goodwill. Which method are we going to use here in computing the goodwill? Are we going to use the full goodwill method, or are we going to use the partial? The full goodwill method or the partial? Yes, automatically here, we do what? We use the partial. We use what? The partial goodwill method. So note number 4, we are told on 28th of March 2023, these are few days to the end of the year, H Limited sold goods worth 100 million to S Limited. So H sold goods to S Limited. And then you're told H Limited reported a gross profit margin of 20% on these goods. And then you're told S Limited had neither received nor recorded these goods in its books of account as at 31st of March 2023. Now, this is basically a consolidation, which you said is not very common, but you'll come across that consolidation adjustment in a number of questions, but not all questions. In fact, that consolidation adjustment is not common. You'll be able to see most of the questions we will do. You'll not come across that, but basically that we refer to that as the goods in transit. The goods in what? The goods in transit. GIT. The goods in transit. Now, for this particular goods in transit, basically, how many adjustments do we make in relation to this? How many adjustments do we make in relation to this? I think like 3 adjustments. 3 adjustments which you make in relation to this. Let me briefly explain. Like in this case, we are told which company made the sales. We are told H Limited. H Limited basically sold some goods now to S Limited, but S Limited had not received nor accounted for those goods. Those goods we refer to them as goods in transit. Now, the first thing we need to do is basically to recognize those goods in the books of account of S, because they were not received nor accounted for by S. How do we recognize them in the books of this? We add them to the group inventory because they are supposed to be part of the inventory of this. And then number 2, this company will need to pay for those goods. We also add them to the group payables. We also add them to the group what? Payables. Sasa, that is first of all to recognize those goods. To recognize those what? Those goods. Number 2, because this company sold some goods to this company automatically made a profit. Now, the profit which was made by this, the full amount will not be realized. The full amount of profit will not be what? Recognized. Sorry, will not be realized. That is, will not be realized. Simply because we say that if this company sells some goods to this, the profit which is made by the selling company can only be realized if the goods are sold to third parties. So therefore, we need to compute the unrealized profit on goods in transit. So this one is computed by taking all the goods in transit times the gross profit margin. Then number 3, this company had not received and accounted for those goods. Automatically, it had not paid for them. That will also give rise to amount of intercompany debt. The amount of intercompany what? Debt. So therefore, as far as the goods in transit is concerned, and that's why this adjustment is not that common, because you can see it requires like 3 adjustments. As far as the goods in transit are concerned, we make those 3 adjustments. Those 3 what? adjustment. So therefore, number one, we have said what we need to do is to recognize the goods. To recognize goods in transit in the books of account of S. So the goods in transit, they had a value of 100 million. 100 million. 100 million. So this one, we add this to the group inventory. And then we also add this to the group payables. That is the first adjustment, to recognize the goods in the books of account of who? Of S. Sasa, number two, we need to compute the unreleased profit. Unreleased profit on the goods in what? In transit, of which this unreleased profit is always by the selling company. The selling company was was H. This one, or this is unreleased profit by H. So how do we compute this? We use that formula here. The goods in transit times the gross profit margin. So the goods in transit, 100 million. 100 million, I hope you can see that, 100 million times the gross profit margin. The gross profit margin is 20%. This will give us 20 million. This one, we less it from the group inventory. And number two, we less it from the retained earnings of the selling company. The retained earnings of the selling company, that is who? That is the H Limited. H Limited is the selling company. H Limited is the selling company. Then the last adjustment is that these goods also give rise to something called, the amount of intercompany debt. Amount of intercompany debt. But in most of the cases, you may also be told that there was another amount of intercompany debt. For example, if you go to that actually that is given in point number 5. Let's go to point number 5. In point number 5, we are told the current account between H and S did not agree due to the goods that remained in transit as per note number 4. As per 31st of March 2023, the trade receivables of H Limited included 600 million from S Limited. Now, that is all about the amount of intercompany debt. But in that case, in the first sentence, we are told the current account of H Limited and S did not agree due to the goods in transit that remained in transit as per note number 4. So, and then you are told that the trade receivables of H Limited included 600 million due from S. Due from what? Due from S. In other terms, what that means is that this company here, that is H Limited, was expecting to receive 600 million from who? From S. So we need to determine how much amount was included within the trade payables of H Limited. Not S, not H, rather S. How much amount was included in the trade payables of this? The trade payables of the subsidiary, because we are told the parent company was expecting to receive 600 million from S. How much amount was supposed to be paid by who? By S to H. And also you must take into account what we have in note number 5. That is note number 4. Note number 4. Who can tell us how much amount was included in the payables of S? Because we are told in note number 5, the current account of H Limited and S did not agree due to the goods that remained in transit as per note number what? As per note number 4. And then you're told that as at 31st of March 2023, the trade receivables of H included 600 million due from who? Due from S. Due from S. Due from S. Now, who can tell us how much amount was included in the payables of S? How much amount was included in the payables? I'm told it's 600. But remember, we are told that the amount which should be included in the payables of these should not be the same with the amount included in the receivables of these, due to what? Due to the goods in transit. Remember the goods in transit? As per note number 4, the goods in transit had a value of this one. So how much amount then was included in the books of account of this? Now, what you just need to note here, I'm told 700, I'm told 120, 600. Now, what you need to note here is that once the parent company here sells some goods to this, are we together? So once this parent company sells some goods to this, so this company accounted for that as sales. This company, that is H Limited, when it sold these particular goods of 100 million, the parent company accounted for that as receivables. So this 100 million is already included here. Is already included in the receivables of the parent. Are we together? Is already included here. And so this company debited the receivables and then credited sales. Credited sales was sales account with 100 million. But now, this company here had not received and accounted for these goods. Had not received and accounted for that good. Now, how much amount initially, before accounting for this, did the subsidiary company owe the parent? That is now the question I'm asking here. Before the subsidiary accounted for, because it had not received and accounted for this good, how much amount did it was owed by the subsidiary to the parent? Yes, that is very much correct. The amount which was included here was 500. Was what? Was 500. And that's why we have said for us to be able to make this to amount to reconcile, for us to be able to make this to amount to reconcile, that's why we have this. When we have that, yes, that's why we have this here. So because this company, once the subsidiary recognized, this 100 million will be added here. Will be what? Will be added here. So this one will be added here. By the end of the day, you'll be able to see that the amount included in the receivables of this is 600 million. The amount included in the payables of this is how much? 600 million. So by the end of the day, those current accounts will do what? Will agree. Will do what? Will agree. Sasa, yes, that's basically what was required here. So therefore, that's basically how we deal with the goods in transit. Recognize the goods, compute the amount of an day's profit, and then determine the amount of intercompany debt. We are done with that. Let's move to the other point, which is point number 6. And you're told an impairment review carried out at the end of the year revealed that neither goodwill arising on acquisition nor the intangible assets. Remember, the intangible asset is this customer's database. This customer's database with infinite useful life had been impaired. So no impairment loss on goodwill. Number 7, you're told to ignore any deferred tax, consequences on acquisition and fair value measurement. And 8, S Limited had not issued any ordinary shares since the date of acquisition. It basically means that since this company was acquired on this date, its share capital has remained the same. The same. And I think we are done. So this question was a very simple one, provided you're able to, I think this was the only tricky note, but once you're able to deal with that note, then the question becomes quite simple. You'll be able to see the requirements, what we are required to compute there is something very, very simple. I don't know whether what is our time here? Let me see. Yes, I think I can give you a short break of just how many minutes? Yes, I think I can just give you a break of 8 minutes. We come back at 7:20. Then we finish on what is remaining. What is remaining should not take us even more than 30 minutes. Yes. So let's take that short break. We come back at 7:20. We continue with what is remaining. Yes, so we continue, and I want us to start with the part A of the question. So if you're back, please confirm. Are you back? Grace, Daniel, are you back? Mike, Patrice, are you back? So if you're back, please confirm, I want us to start with part A. Okay, so let's start with part A. And basically what you're required to do is we determine the equity accounted value of the investment in S Limited on 31st of March 2019. In other terms, what you're required to do here in Roman 1 or in part A is we determine the investment in associate, on this date here. Remember, this company here that is S Limited, or basically the parent company acquired initially 40% of the shares in S. So S Limited was initially what? Was initially an associate. So what we are required to do is we determine the investment in associate on this date. The date the parent company acquired the control, or what was the value of the investment in associate before this company became a subsidiary. Became what? A subsidiary. So therefore, we are required to compute the investment in associate. So remember, associate is basically S Limited. On which date? On 1st of April 2019, which is the same with 31st of March 2019. Are the two dates the same? Yes. 1st of April 2019 is the same with what? 31st of March 2019. So how do we compute this one? So the same approach we use in computing the investment in what? Associate. So remember our figures are in million of shillings. So we will start with the cost of investment. The cost of investment. How much amount was paid by the parent company in acquiring 40% shareholding. And then to this, we add the group share of the post-acquisition retained earnings. So to compute this, that is the group share of post-acquisition retained earnings. If we go back to that question, you'll be able to see we are given the retained earnings of this company between these two dates. Between those two dates. So the difference between the retained earnings between these two dates will be the post-acquisition retained earnings. And basically, we get the group share of that, which will be 40%. So and then to this, we said we less any impairment loss, of which there is some information which are given in note number 6, where we are told that the investment in associate had not impaired. So therefore, what is the cost of investment? When the parent company acquired 40% shareholding in S, how much amount was paid? That information, we have it within paragraph 1. Let's go back to paragraph 1 of our question. Specifically sentence 2, we are told H Limited acquired 40% ordinary shareholding in S on 1st of April 2013 for 2,500 million. So that is 2,500 million, the cost of investment. And also in the same point, we are told when the retained earnings stood at 360. So the retained earnings on this date was 360 million. And I think also we are given the retained earnings of this date. The retained earnings on the date the parent company acquired the control, and that is in note number 1. In note number 1, sentence 2, we are told at this date, that is the date when the parent company acquired the control, the retained earnings of S was 860. So the post-acquisition retained earnings of this company here will be the difference between these two retained earnings. Because this one is pre-acquisition retained earnings, whereas this 860 is post plus pre-acquisition retained earnings. Yes, so this is comprises of both pre and post, and then the pre is how much? Is 360. So the post-acquisition will be the difference between those two retained earnings, 860 minus 360. So basically, which will give us what? which will give us 500, and then we get the parent company share of that. The parent company share of that will be 40%. 40% of this. 40% of this, or basically 0.4. So, and that will give us what? That will give us 200, 200. Is it 200? 500 times 40%, 200, yes. So we add these two values here, and basically that will give us what? That will give us 27. So this basically what was required in Roman 1 of that question, and the marks allocated there were just 2 marks. So that and that, 2 marks. So we move to part B of the question. Part B of the question, and what are we required to do? We are required to compute the goodwill arising on acquisition of S. So the goodwill on acquisition of S, on acquisition of who? S Limited. And remember, as per the information we have in note number 3, we are computing this goodwill using the partial goodwill method. As per the information we have in note number 3, we are using the partial goodwill method. So here we need to have, let's just have 2 columns. We have 2 columns like that. 2 columns, and also our figures are in million of shillings. So how do we compute this goodwill? Remember, I've given you the format for computing the goodwill arising from piecemeal acquisition. One, we have said we compute the goodwill on this date, the date when the parent company acquired the control. How do we compute that? We start by taking the cost of additional investment. The cost of additional investment. How much amount was paid by the parent company in acquiring this 30% shareholding? This 30% shareholding. This 30% shareholding. Yes, that one should be 27 because this 500 times 40%. That's right? Yes. So the cost of additional investment. This one we have it in note 1. Note 1, note 1. This is basically where we have this. Note 1. So how much amount was paid by the parent company in acquiring additional 30% shareholding? The cost is 22. 22. And then now to this, we add the fair value of the original investment. Fair value of original investment. Original investment is that 40% shareholding. And the fair value of the original investment, still we have it in note 1, sentence 2. At this date, the retained earnings was 860, and the fair value of the previously 40% interest was 3,000. That is basically the fair value of the original what? Investment. Now, if, for example, we are using now the partial goodwill method, so here we also come and we add the NCI at fair value. NCI at fair what? Value. We only add that here when using the full goodwill method. But in our case, we're using the partial. So this will give us 5,200. 5,200. And then now to this, we need to proceed. And basically, we do what? We less the fair value of net assets acquired. The fair value of the net assets which were acquired. Fair value of the net assets which were acquired. Fair value of the net assets which were acquired automatically is something which the examiner will not give you. In most of the cases, how do we compute this one? We compute this by taking the ordinary share capital of S on this date. Ordinary share capital of S plus the pre-acquisition reserves. The reserves which S Limited was having on this date. 1st April 2019. 1st April 2019. Okay. So I've said we less fair value of net assets which were acquired. And basically I'm saying that this one would be equal to the subsidiary company subsidiary company ordinary share capital. So the subsidiary company ordinary share capital, this one we have it within the statement of financial position. Let's go to the statement of financial position of S, specifically at the equity. So how much is the ordinary share capital of S? Who can see that? Ordinary share capital of S. Yes, the ordinary share capital of S here is what? Is the 5,000. So then below that, we have the retained earnings, but basically that retained earnings we know is at the end of the current year. So what we are interested with is the retained earnings on this date here, 1st of April 2019, when the parent company acquired the control. And that retained earnings, we have it in note number 1. Let's go to note number 1. Note number 1, sentence 2. At that date, when the retained earnings of S amounted to 860. That is the retained earnings on 1st of April 2019, when the parent company acquired the control, 860. So in the statement of financial position and the equity, I hope you can see we don't have any other reserve. We don't have any other reserve. Maybe what else do we need to include here? We need to check whether on the date of acquisition, this company revalued assets. Did S Limited revalued asset on the date of acquisition? Yes. As per note number 1, we know that this company revalued 2 assets. It revalued plant. There was a revaluation gain of 150, and also it revalued these intangible assets. And the value for that was 90. So therefore, we have a total revaluation gain of 150 plus what? Plus 90. This one plus this one. And basically that will give us what? That will give us 240. Any other pre-acquisition reserve? We don't have any other. We don't have any other. So we get the total here. We get the total, which will be 1600. That is basically 5,000. Yes. 860 plus 240. Yes. That basically will give us 61. 61. Now, because you're using the partial goodwill method, we're interested with the net asset acquired by the parent. The net asset acquired by the parent will be 70%. 70%. But if we were using the full goodwill method, under the full goodwill method, we take 100% of this. But under the partial, we only take the net asset acquired by the parent, which will be 49 what? 70. 49.70. We less that from you're getting what? 42.70 parent. 42.70. 42.70. That is correct value. 42.70. 42 what? 70. Okay. So we less that from the amount we have here. And basically we get goodwill. We get goodwill. And the goodwill will be how much? Will be 930. 930. Also recall that goodwill is not impaired. So that basically what is required as far as that point is concerned. The marks allocated there were 4 marks. What is marked in such a case? This, that, and that. So you'll see for any 4 correct item, you get 1 mark each. So you get 4 marks there. So finally, we move to part C. So what are we required to prepare? We are required to prepare the consolidated statement of profit or loss. Okay, consolidated statement of financial position as at 31st of March 2023. Now remember what we have said is that in case of a piecemeal acquisition, if you are required to prepare this consolidated balance sheet, consolidated statement of financial position, what you just need to do is to establish the status of this company at the end of the year. At the end of the year, S Limited will be what? Will it be an associate? Will it be a subsidiary at the end of the year? What would be S? S Limited will be a subsidiary. Being a subsidiary, we then do a full consolidation. We then do a full consolidation. Full consolidation means that we combine similar items of assets and liabilities, those of S, and those of who? Those of H. Those of H. So we do a full consolidation, a full consolidation. So we just need to have a single column here. And automatically we will start with the non-current assets. With the non-current assets. So for the non-current assets, I think we have basically a number of them. We go back to the statement of financial position for individual companies. We start with the first item of non-current asset, and that is the property, plant, and equipment. So we take that of the parent, that is H, 5550, plus that of S, which is 42. And then we have some consolidation adjustment here. In relation to this revaluation of plant, we add 150 here, the revaluation gain. And then we have this depreciation other charge of how much? Of 100, which we said we less. We less from the PP. From the PP. Do we have any other adjustment affecting the PP? No. So I think we will come back and do the totals, but let's first of all, we have all the items here. So then below that, we have investment in S. Are we supposed to include the investment in S here? No. So instead, what we include here is the goodwill on acquisition of S. The goodwill on acquisition of S. The goodwill on acquisition of S is what you have computed there, 930. Before we proceed to record the non-current, the current asset, recall this company that is S Limited on the date it was acquired, there was a database of customers. And actually we say that database of customers should be recognized as what? Intangible assets. So we have intangible asset. We should take intangible asset to those of the parent, which is 0, plus this one belongs to the subsidiary, which is 90. And basically that will be 90. Remember, no amortization. Yes. I think you have already gotten the final value for this. The final value for PP. I hope you have already gotten that. How much is that? 9,800. 9,800, like that. Okay, so we move and we record the current assets. We record the current assets. So for the current asset, we have inventory. Inventory. So inventory, we record that of the parent, 27, plus that of the subsidiary. Do we have some adjustment affecting that? Yes. Number one, we have these goods in transit, which we said we need to add them to the goods to the group inventory. So we add the goods in transit. These are goods in transit. And I think we also have unrealized day's profit, this one, 20, which we said we less from the group inventory. We less 20, which is unrealized day's what? Profit. We get the final value there. That should be 45 plus 80. 4580. Is that what you're getting? 4580. Okay. 4580, yes. So then we have the receivables. The receivables we have that 120 plus 2180. And then we have the amount of intercompany debt. This one, amount of intercompany debt of 600. So this one will be deducted there. So any amount of intercompany debt, remember, this one should be deducted from the receivables. I think we forgot to say that. And then this one, and basically that is the total of 600 million. This one will be deducted from the group payables. From the group what? Payables. We just start from the group receivables, this one from the group payables. Yes. So basically what do we get here? What do we get here? should be 53 minus 600, which will give us 47. Then from there we have the cash and cash equivalents. We have 1130 plus 770. Any adjustment to this? No, because we don't have any cash in transit. This one is only adjusted with the cash in transit. And basically this will give us a total of 1819. 1900. 1900, is that what you're getting? Yes, 1900. Yes. So basically, no need of getting the total assets. We proceed and we record equity. So for equity, we take the ordinary share capital. And remember here, we said we only record the ordinary share capital of who? Of the parent company. Of the parent company only. Of the parent company only. So in the case of cash in transit, and we add it. That one should be added to the cash and cash equivalents. So here we record the share capital of the parent company only. So the retained earnings, we say that moving forward is one of the items we will not be computing. Let's just ignore that one. Because we said even in an examination setup, we will not have time to compute this. No need of computing that. Moving forward, we will not be computing that. Because we said for these particular questions, you don't have to balance. You don't have to get everything correct for you to get all the marks. So then from there, we say there is also something else which should be computed and included there. The non-controlling interest, equally we can ignore that. Actually, we say these are two items I will not advise you. If you're doing this particular question in an exam, I will not advise you to compute those two items, the group retained earnings and the NCI. So we just ignore them. And then from there, we proceed, we record what? We record the liabilities. We start with the non-current liabilities. So we start with the 10% row notes. So we take that of the parent, which is basically 18, plus that of the subsidiary. Do we have any adjustment for this? No adjustments. We get the final value. And then finally, we have the current liabilities. We have the trade payables, which is basically 1516 plus 840. Any adjustment for this? Yes, we have amount of intercompany debt. This one, 600. We rest it here. We rest that there. And basically this one should be 2400 minus 600, which will give us what? 1800. 1800, is that what you're getting? Yes, 1800. Finally, tax. Now, there is something I think I mentioned in our previous class. Anytime you come across a question for group account, and there is a component of tax, whether it is in the income statement, whether it is in the statement of financial position, this one is always pre-marked. No single time you'll be told an item for tax is to be adjusted in any question for group account. Sasa? Yes, tax, whether it is in the income statement, because even here you may have deferred tax, always these are pre-marks. We just need to add 350 plus 200 and what? 50. And that will basically give us what? That one will give us 600. That one will give us what? 600. That one will give us 600. So that question, if basically leave it at that point, even without computing those two items, you'll basically be able to get all the maths. Because in most of the cases, in terms of how this question will be marked, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. In most of the cases, this is how the question is marked. Any 7 at 2. You need to get 7 items correct. For every correct item, you are allocated how many marks? You are allocated 2 marks. Yes, so the whatever we should rest here from the payables should be 600. should be 600. Sasa should be 600. 600, not 500. Because in this 500, this amount was not included. Remember this amount, which we said we are going to add to the payables? That one was not included here. That's why we added that in relation to the goods in transit. In relation to the goods in what? In transit. In relation to the goods in transit. Yes, yes. So that basically what was required as far as that question is concerned. And I've said it's not a must. You get all the marks, because mostly this is how the question will be marked. Was actually marked, that is. Any 7 correct items, how many marks? Basically 2 marks for each. And you can see so many free marks here. Like what? Like maybe share capital. These are free marks. I've said any component for tax. This one is also free because no adjustment for that. No adjustment here. Yes. So yes, I think those are basically some of the free what? Free marks which you could have gotten as far as that question is what is concerned. As far as that question, question is what is concerned. Yes. So now, if you go through those past papers, you'll be able to see so many questions of this. So many questions on piecemeal or basically stage acquisition. What I'll do, we will only do one question because of time. But basically, once we start our revision, we will be able to do more questions on this. So I'm hoping that by 3rd of November, because I'm hoping that we should be done with this by Monday next week. Sorry, Tuesday next week, we should be done with the topic of group accounts. And then I think we will be having 2 classes remaining within that week. I think the main topic which is remaining is on reconstruction. I think reconstruction, we will do that within 2 classes. But definitely we're going to do more questions during our revision. But we will do something to do with the internal reconstruction 1 class, external reconstruction 1 class. And therefore, maybe what will be remaining are some theories, and then revision. So hoping that next week we should be done. And then I'm hoping that by 3rd of November, we should embark on revision. We should embark on what? On revision, because what is important as far as these papers are concerned is that revision, that revision. So what we will be doing, for example, during our revision, we will be agreeing on the topic to revise, and then you take some time even before we meet here to revise that topic. You go through it, you go through that topic on your own, you remind yourself of whatever we discussed in class, and then once we come here, we just do some questions. Sasa, yes. So we stop at that point for today, and then what we will do once we meet, is it tomorrow? Tomorrow we move to a different concept of group account. We will be able to look on something called disposal of interest. Disposal of interest is whereby the parent company is selling some shares, or maybe all the shares in a subsidiary. How do we prepare the group account? So which you'll be able to see the concept is just the same with piecemeal acquisition. And therefore, we are going to look on how we prepare the group, the group account, and equally how do we compute maybe the goodwill arising, or maybe not the goodwill, sorry, something called the gain or the loss on disposal, because the parent company is selling some shares or all the shares in what? In a subsidiary. We will be able to look on how we compute the gain or the loss on disposal. Fred is asking about the goods in transit. Goods in transit, I've said, Fred, there are 3 consolidation adjustments. 3 consolidation adjustments. This is just what you need to understand. This company has not received and accounted for those goods, so we need to recognize them. We debit the inventory, we credit payables. To debit the inventory is to add. To credit the payables is to add. So we add payables, we add those goods to the inventory. You'll be able to see that what you have done here. Number 2, because this company had not received an account and sold those goods, so automatically the profit which was made by the selling company, the full amount of the profit was not realized. Compute the amount of unrealized profit based on all the goods, based on the goods in transit. You less that from the group inventory, That is the key consolidation adjustment, because the other adjustment is to be deducted from the retained earnings, which you're saying no need of computing that. Number three, those goods will also give rise to something called the amount of intercompany debt. This company had not received those goods, automatically it had not paid for them. So this company is demanding 100 million from this. This one will be required to pay 100 million to this. So that gives rise to amount of intercompany debt. Three, consolidation and adjustment. That's that? Yes, yes. So I think let's just stop at that point for now. We stop at that point for now. We continue from there tomorrow as we move now to the different to the next concept of what? Of group account, which is basically the disposal of interest. So let's stop at that point. Have a good night. See you tomorrow.
The question asks when, the one you projected now. So let's check on the one that is on the screen, which has said that I look at it. So the question is asking, Max Weber, the way theory of management remains applicable in modern organizations, especially environment where what? Where order, efficiency, product, predictability, and control are critical. Highlight if it's the main one, Weber's theory is applicable. So which areas basically, or which institutions whereby you can apply? I think on this one we are done, but for the sake of repeating. So as I handle this question, I want you to identify where we were last time. Eh? So as I handle this question, please try to find out where we were so that you can move there very fast. Now, basically, talk about Max Weber. It's about bureaucracy, a lot of processes, a lot of procedures. Bureaucracy basically means what? You follow a lot of processes, a lot of procedures. Now, you are asked where situations, which situations can be able to force you to use this Max Weber bureaucratic theory. Now, the situations are listed here. The situations have been listed here, and the first one, just a minute. So let's look at the situations. Number one is public institutions. You know that in the public institutions, there's a lot of bureaucracy. Applying for a document, basically, it normally takes a lot of time. So basically, you know, in the public sector, the process is normally very bureaucratic because what? To be able to what? To check on the aspect of what? Reduce unethical behavior. Because in the public sector, basically, that is our taxes, me and you. So that's why you have to put a lot of process so that somebody don't find it easy to be able to misuse somebody's fund. So we talk about the public sector government agencies often require strict adherence to laws, rules, and procedures which align with what? Weber's what? Creative principles. So if you look at the government sector, application for any, even a document, even a birth certificate, basically, there's a procedure. You cannot just apply the way you want. There's normally requirements, attachments. So there's some aspect of what? Bureaucracy. You cannot just use shortcut to be able to get those documents. Number two is large manufacturing firms. Basically, they must be bureaucracy because when you when you're doing manufacturing, one thing that will happen is that you produce in large quantity. When you're producing in large quantity, there's bound to be aspect of quality measures that have to be in place. So if you compromise the process or the stages, then basically you can compromise the quality. So to ensure that you continue producing the right quality, you must ensure that what those rules, regulations, and laws are followed to the letter, or they are adhered to the letter. That is basically called what? Call it what? So that where the repetition and quality control are critical, Bureaucracy ensures uniformity and efficiency. Because when you're producing goods, basically, if you're producing loaves of bread, there's aspect of uniformity. If it's about 600 grams, you produce 600. So you cannot find something, some are 30, 50. You normally ensure that what? In terms of quality, in terms of quantity, then the quantity remains the same. Even if you produce what? 1,000 or 1,000,000 unit, that is very, very important. It's a very important aspect you have to look at. Another is what? Healthcare institutions. Basically, matters health, there's no shortcut. In matters health, regulations have to be followed to the letter. Because if you take a shortcut in matter health, somebody can die. You can use, you may do something that we may even what end up losing somebody or end up losing life. So basically, it's important. So also, a health regulation rules rely on strict protocols and hierarchical structures for safety and legal compliance. Now, talk about strict protocols. There are protocols we followed. When somebody faints, there's a protocol. When somebody has had an accident, has broken limbs, there's a protocol. You cannot come with your own way of doing things. There's a way in which what? When an ambulance comes to the site of an accident, there's a protocol. You don't just come and carry people. There's a way to do their things. So basically, that's a procedure. So that if you go against the procedure, you can even be sued. You can even sue God, of course. So basically, it's important that what we look at those aspects of in health because what the nature of the institution. When we talk about healthcare is very what is very, very critical in, and also it's an area that if you make a mistake, then basically you may end up what causing a lot of damage, and even what loss of life may occur. Then number 4 is what military and police forces. This is where order is normally being used. In military or in police, you don't question. If you're told to march, you march. If you're told to move forward, you move forward. If you're told to shoot, you shoot. Basically, that's called what? Order. So in those cases, you don't have time to reason. You don't have time to reason until this is what, no. What happens is that in this case, you need to ensure that what? You follow order. If you want to resign as a military officer, there's normally what? A rule to follow in ordering. So basically, that is very, very important. Very, very important to look at. Then next one is regulated industries, e.g. banking and aviation. Now, when we talk about banking, in the banking sector, I don't know if you're going to the bank, and sometimes you even feel bad. You're told to do a signature, and then your signature varies slightly with what you had signed when you're opening an account. Then start feeling bad. Say that's why are you denying me my money, and I'm the one you can confirm my face. Because there's what's called protocol. We can know you, this is you, but basically you have to give a good signature. You have to sign the way you normally sign. That is called protocol. When we talk about aviation, flying of planes, landing of planes, there's a protocol for starting a plane and flying a plane. There's a protocol for landing. You cannot land the way you want. You have to follow certain procedures. If you miss those procedures, basically you can bring a you can end up causing a very, very, very big accident. So it's important that we look at those aspects very, very, very carefully. So I don't know if that question is asked well. I don't know if the questions are answered or is a question you need me to elaborate again. Any question? Any question? I think there's somebody who asked me to look at that question, and I think I've been able to repeat it. So if you have a question, okay, I'm guessing. Let me get a clarity from what I think this is Mbuche. Mbuche is asking. The question asked when. It's confused because what they asked discuss situations. Now, let me read that question so that we get to understand that point very clearly. That highlights 5 situations. Situations when you apply the theory. Maybe the way the structure is the way the questions are, the answer are put could be. Now, if you look at the introduction part, how I've introduced it. Look at what the answer is. Look at how I've introduced the answer. That Weber's rule theory is best suited for structured, rule-based environment. Is applicable in the following situations. The first situation was in the public sector. If you're in the public sector, whether county government or national government, basically you apply, or person you apply the rules. In large scale manufacturing, you see, the answers look a little bit, I don't know, there's an aspect of non-clarity, but if you look at how I've been able to introduce them, I've talked about the situations that can happen. So I understand where Ambuche is coming from. Ambuche, maybe you expected us to say, for example, the first situation could be areas where we need what? Strict adherence to law. That was what you ought to have, you are expecting that we say that number one, a place where there's what? There's strict adherence to law. Number two could be a situation where there is standardization, repetition, and quality control. Number two. Number three, we talk about what? An area which is what? Controlled by a lot of regulation, as a field or an industry which is what? Controlled by certain authority. And then also what? Talk about what? Areas with the what? The strict regulatory framework. So basically, understand how you come. But basically, you can, in both cases, you can still be able to what? To answer that question, get the question right. I don't know if Ambuche now you understand. So understand what you're saying, eh? We have talked about, we are talking about, in this case, I've been able to talk about institutions, eh? But the question was asking when. So basically, maybe how I'm explaining the institution, that when comes in. But I understand your point. Your point is so very very correct, because you talk about what? You talk about them, and then you give an example. For example, you talk about number one, you talk about, for example, industry where the strict adherence, then you explain, then what? Example, public sector institutions. So basically, that would be also a better way of answering. That's also another way of answering. So I don't know if now it's clear, Ambuche. Is it now clear? So I understand now the situation. I think I've been able to illustrate the confusion. Now we're good. Now I'm asking because people are quiet. I can't really remember where we were. So I was asking, where were we last time? People are quiet. I don't know if we didn't indicate where we were, or we didn't indicate. So which paper were we doing last time? I may not be able to remember, so I'm requesting that in case anybody with an idea where we were last time? Anyone with an idea where we were last time? Anyone with an idea? You want to proceed? Or I just select a paper? Okay, since we are not sure, nobody is sure, I'll select a paper, then we can be able to look at it. So, I can see somebody has written something. So, somebody has written something. Okay, so random paper, but I don't want a paper that we have discussed before. So random paper means I have to come down here. The ones that I'm sure we have not been able to cover must be papers which are now down here. So let me select another paper down here, which this one here. April 2024. This one you're done. Group decision making, this one you're done. This one you're done. So can you see that one you're done? This one. Marketing research, this one you're done. Company text marketing research, that one you're done. Let me look at another question here. Business incubation, access body, this one you're done. Incubation, you're done. This one now. I think this one now. Yes, this one I think we are not done. So let's look at this question, number 6, so that we don't take much time. We can proceed as a group. Now, this question is asking, the question asks, outline 5 types of decisions made in a company. So if you have an organization, which are some of the types of decisions that are likely made in a company? So I want to look at some of the types of decisions that are likely to be made. Number 1 is called strategic decisions. So these are long-term decisions made by top management. They define the direction of the organization, such as what? Entering new markets or launching a new product. So when we talk about strategic decisions, these are normally made by the strategic level management, which is basically the top level management. And their work is to ensure that what? These are basically, for example, we talk about issues like entering a new market. That is the decision that has been made by top management. They sit down and say that now we want to expand. So we want to expand to which markets? We want to expand to Ugandan market. So basically, that is one of the decisions. Then number 2 is what? It's called tactical decisions. The second one is called tactical decisions. Which are these decisions? Now these are made by middle level management. You see, strategic decisions are normally made by top level management. Now, these tactical decisions are made by middle level managers, means in between. These decisions focus on how to implement strategic plans effectively. For example, developing marketing campaigns or recruitment plans. So basically, those are called tactical. They are normally mid-level management decisions. So once the top level has made strategic decisions, now implementing them is normally what? Done at that level. The number 5, we have what's called operational decisions. Operational basically means what? These are day-to-day decisions. These are normally decisions that happens on day-to-day. Operations, you come. Those are, we call them what? Daily decisions, or decisions that are made on daily basis. So that these are day-to-day decisions made by lower level managers, so managers or supervisors, to ensure routine tasks are completed efficiently, such as scheduling staff or managing inventory. So basically, operational decisions are made by what? The junior level or the lower level managers, and they are normally what's called day-to-day operations. We give an example there. Now, the first thing we talk about, strategic number decisions are normally made by top level management, tactical mid-level management, and then what? And then operational, basically, the lower level management. Then the next one is called program decisions. They say the way the name suggests what's called program, means they're repetitive. When we talk about this is how this system is programmed, means it can do a repetitive task day tomorrow without any problem. So these are repetitive and routine decisions made by following established guidelines or rules. For example, reordering stock when it reaches a reorder level. So things like when you want to order, do procurement, there's normally what? A program. There's normally a procedure to follow. So you repeat the same. If you're buying laptop for the company this time, you follow the same procedure. If you want to buy a car for the company, the same procedure applies. So basically, we call them what? We call them program. Because what? You every time you follow the decision or the procedure again and again and again, depending on what you're doing. Then you have what's called non-program decisions. This could be a one-off decisions that you make in a company. So that this involve unique or unstructured problems that require custom solution. For instance, handling a crisis or responding to what? Unexpected competition. So these are things that can come. For example, talk about responding to an unexpected competition or handling a crisis. Nobody is prepared to, a crisis comes sometimes when you least expect it. So when you want to manage that crisis, you may make decisions. That's what call them what? Call them non-program. Means there are things that you didn't expect, but now since they occur, you have to what? You have to find a way of what? Of handling or managing those decisions. Very, very important. That's what you look at that, look at it very carefully. Now, that is on number 1A, question 1A. Question 1B, somebody has a point here. Let me see. Let me see what is being handled here. Consensus, participative, type of decision, basically. Consensus, those are basically decision-making techniques. Wendy, consensus are called, these are called what? Decision-making strategies or techniques. I don't know if you're getting me, Wendy. They are not types of decisions, but basically, consensus is a decision-making technique, participative also. Basically, those are techniques, but the question was asked about what? Asking about types of decisions. So that's a very good trial. At least you've been able to get a clarity on that. So that's okay. Now, the next question here is asking, Joseph Mwala, the marketing manager of XYZ company, intends to collect marketing information to enable the company make marketing decisions. Identify first of such information. So you want to collect information about marketing. So the question asks, where can you be able to what? Or which areas can you be able to collect such information? Or where do you get this marketing information? Where can you get them? Number one is what? You can get them from what's called internal company records. You can look at the records of the company and get records about sales for the last 5 years, sales record, projection, and all those things. So sales data, you can look at the sales data, how sales has been happening, customer feedback on sales, financial reports, and CRM. CRM means customer relationship management systems, provide useful insights into customer preference and business power. So basically, you can be able to look at the records of the company, which include sales data, customer feedback, financial report. All this one what can help you what make a very informed decisions. Number 2 is what? Marketing research. You can also do research. When you do research, when you do marketing research, you are likely to come up with what? Or you're likely to come up with a very good marketing information that may not be available. So we say that involves systematic collection and analysis of data from surveys, focus groups, and interviews to understand market trends and consumer behavior. So you can also decide that, okay, I don't have information. What do I do? Let me do a research, and then from the research, I'm able to what? Get my findings. And my findings can be a source of very good information. So that is also an area of look at. Market, you can do a research, and from the research, you can get what? Some very vital information. The next question is on competitor analysis. The next source is competitor analysis. You can be able to what? You can try to analyze the competitor, and that one can also help you. So what do you mean? So information on competitors' pricing, you can look at how much are they pricing product in the competitor pricing. Promotion, how do they do promotion? Do they do online marketing promotion? I will check on that. And product offerings, what are they offering in the market? What's their pricing? Help in benchmarking and strategy for me. So basically, you can also collect what? You can also collect competitor. You can look at a competitor now and collect very important information. Number 4 is what? Government and industry records. So basically, platform records. Basically, there are a lot of reports that are very important, especially in the Kenya, we call them what? In the Kenya Chambers of Commerce, you can get a lot of information, or from the what? From the National Bureau of Statistics, basically. You can get more information about marketing, about products, about production, about industry. So basically, you can also get what? Some information for research from those kind of institutions. And then number 5 is online and social media platforms. Basically, you can be able to get, you can even do a survey on social media, and people are going to respond. So basically, you're able to get information. So those are some of the 5 sources of information that you can be able to to use in marketing, or you can be able to get and then what? Apply in marketing. I don't know if that question is clear. I believe it's clear. So we can move to the next one. Next question is asking, analyze 5 methods that could be applied in innovations to enhance employee creativity. This is another question that has been repeating itself a lot of time. So analyze 5 methods that could be applied in innovation to enhance employee creativity. What can we do to improve employee creativity as in a company? What are some of the measures you can do to ensure that the employees you have are very creative? They're very creative. Now, number one is what? Encourage open communication. That's very important. If you want to be in a creative environment, then encourage people to what? Communicate. Let them tell us what the ideas they have. Let us tell them why they think the ideas. So basically, communication. So creating an environment where employees freely share ideas without fear or presume promotes innovation and original thinking. That is very important. Very, very important. So basically, encourage a lot of communication. So if people communicate, then basically it becomes easy for us to be able to what? Be able to be creative, because any idea, if somebody has an idea, then basically they can be able to what? They can be able to share that idea, and that can really help. Number 2 is what? Providing training and development. You can also train people on areas of what? You can also train people on how to be creative, areas of creativity. So you can also what? Take people training. You know, a well-trained employee is able to be creative. So that equipping employees with skills in critical thinking, so that they think more than the ordinary person. Critical thinking, problem solving. They can also be creative. If there's a problem, then they can come with what? A creative way of solving the problem, creative techniques, techniques through workshops fosters innovation. So you can do a workshop, and that can really help them. Number 3 is what? Establishing a reward system. This is also very good. You should ensure that what? Those who are creative or those who bring in new ideas, if their ideas work, then basically they are rewarded by the company. So that one encourages creativity. So that last year, so and so came up with an invention. The invention has helped the company. It was paid 10 million shillings for that invention. So basically, everybody else wants to be able to be innovative or creative. That's what they're able to work. They're able to earn from. So you encourage that by what? By compensating those who come up with what? With the new idea. Or those are the most creative employees are normally are compensated. That one makes it better. Number 4 is creating cross-functional team. Anytime you hear us talk about a cross-functional team, means it's a team made up of individuals from all other departments. We have somebody is from marketing department. We have somebody from accounting department. We have somebody from procurement department, somebody from HR. So basically, all the team that you have has experts from all over the departments or experts from all other departments. So basically, that one makes it easier, because when an issue of accounting comes in, there's an accountant there to help us understand. If an issue of marketing comes in, there's a marketer there. So basically, with those kind of information, you are able to ensure that what? You're able to ensure that you encourage creativity, because what? If you want to think about HR, then basically I can consult the HR in the team, and basically he or she is able to she'll be able to give me some insight, and that one can help in being creative. That's very, very, very important. Then number 5 is what? Allowing autonomy and flexibility. What is autonomy? We talk about autonomy is what? Allow employees to feel like what? To feel, allow employees to be a little bit, or allow employees to be independent. Let them do their work without any employees like being. When you give somebody autonomy, then basically they're able to work. They're able to ensure that works. They're able to be creative. If you give me work to do, don't follow me up so much. Allow me to use my skill to solve that problem. That's called autonomy. So Giving employees freedom on how to approach tasks and solve problems can lead to what? Unique and effective solutions. So don't always tell them that give them a problem, but let them use their own skills, their own intelligence to solve the problem. Don't wait until now, or don't give them a problem and then you want them to solve the problem. Ensure that what? You try as much as possible to allow them to use their own skill to solve. They become creative in solving that problem. What's the problem? Wendy, you have written something called in control. What does that mean? What do you mean in control? I don't understand what you're asking, Wendy. So I'm just asking for clarification. You have written in control. What does that mean? Oh, yeah. So, I understand now. Basically, autonomy means what? You're given freedom to what? To control what you're doing. That's okay. Thank you, Wendy. Now, question 2 is asking, Nyatesh is asking, can point 5 be named as business culture? Let me look at that point 5 and then we see if you can look at them. Allowing autonomy and flexibility. So basically, autonomy. Yes, autonomy is a business culture. There are some companies whereby what? They give employees freedom to solve the issue. They're given a problem and they're given. That's their culture means once I give you a problem to solve, I don't follow you up. That's a culture. But the place whereby you're given a problem and you're given a structured way of solving it. There's no autonomy there. It means what? I'm giving you a problem, but I give you how you're supposed to solve it. So autonomy or not having an autonomy in a company is a culture. There are some companies with autonomous cultures, others don't have the autonomous culture. So that's a culture. It's an culture aspect. It's an aspect of culture in the company. I don't know if you answered. I don't know if you answered, Nyatish. Are you well answered? Let me know if you answered so that I can proceed. Okay. Nyatish is answered. Nyatish is well answered. So we can proceed. We can proceed to the next. Now, question 2 is asking, question 2A asks, outline 4 internal factors that affect planning within a company. So which are some of the factors that affect planning? But these question is very specific. These factors must be internal factors, means they are factors within the organization. So which factors within the organization can affect how planning or can affect planning as affect planning as a function of management? Number 1 is organizational resources. So your plan must be subject to the resource you have, both human resource, financial resource, and capital resource. If you don't have enough money, don't go for a plan that requires a lot of money and you don't have it. So see that one. The availability of financial, human, and physical resources directly influence the feasibility of plan. That's very true. So basically, planning your plan depends on what? On how much money, even at your level. If you're planning on how to spend your money, you look at how much money you have time. So you look at the money first, this is what I have, then from that one you plan. You don't plan, then look for the money. You look for how much you have, then you plan with that, basically. Now, what is the company culture? Basically, your plan must be within the culture. So the company culture is also a very important factor that, or is also a very important factor that basically affects planning. Now, what does that mean? So we say that the values and beliefs within our organization can either support or hinder strategic planning. So the culture that you have, you can have a culture that supports planning, or you can have a culture that does not support planning so much. So basically, the culture of the company determines how planning is, or determines what, how you undertake planning, or how planning is undertaken. That's very, very true, very important factor. Then number three is what? Management style. That's a very important part. How you manage. Are you autocratic? Are you democratic? Do you use legislature? So basically, the management practice or the management technique will definitely affect the planning. So that authoritative versus participative management style affects how plans are developed and implemented. So if you are an authoritative manager, then what happens is that what? You decide on the plans yourself and then tell employees to follow the plan. If you are participative manager, then basically you call people and then you agree as a group on how to come up with a plan and how to implement it. So that is basically what happens. Very, very important. The next question here is organization. The next point is what? Organization structure. Basically, structure you have will affect how you plan. So we say that the way roles and responsibilities are distributed can very well translate or complicate the planning process. So the culture you have, the structure you have, the structure can either support a plan or frustrate or inhibit implementation of plan. So the company culture or structure also plays a vital role in what? In the planning process that is done. The next question here is asking, somebody has written something. Let me try to get what has been written here. Skills and knowledge of the employees, very true. If you have very skilled and knowledgeable employees, then basically they are going to help you implement the plan very easily. If you have employees who are not skilled and not knowledgeable, then basically implementing or planning function can be difficult in that company. So that's another one. I agree with that. That's very true. That's very true. From that point. This, what time? From what time? You're supposed to go prayer break at what time? We normally go at 7. Now today, what you want us to go at what time? Or it varies? Or 57, there's no problem. Today it's coming early, so there's no problem. We'll leave at 50. Now the next question here is asking. The next question is asking 6:57. Huh? Okay, no problem. Now the next question is asking, summarize 6 types of organizational change in the 21st century. So what are some of the changes that you see right now, currently? 21st century is currently where we are. What are some of the types of the number one call is technological change. You see that technologies keep on what changing. It keeps on advancing. So basically, technological change is one of the change. So talk about adoption of new technologies like AI. AI is taking over automation and digital platforms. So basically, in this century, then basically we have what technological change. Number 2 is called structural change. The structures changing. So modification of hierarchy, roles, and reporting is basically structure. We talk about the structure change means what? The company structure keeps on changing in terms of what? In terms of hierarchy. We look at the hierarchy and if it's suitable, we implement. If it's not suitable, we change something. Talk about roles. Even roles of managers are changing, are drifting. Roles of managers, roles of employees. Even accountant. The roles of accountants in 1980s or the 1970s is not the same as some. There's some roles which have been added additionally to what? Accounting profession. And then reporting. Who do you report to? Number 3 is what? Strategic change. You must, this is very important. You must change your strategies to ensure that what? You're able to what? You're able to survive. So a shift in direction, vision, or goals in response to what? Market demand. So basically, your strategies must change in terms of your vision must change, your mission must change, and even your objectives must change. So basically, that's right, change. The number 4 is called cultural change. Companies are changing cultures. So transformation of values, norms, and work ethics. So the values of the companies are changing. Values are accelerated here. So basically, if you look at the values of company in the 1960s and now, they're really different. Norms are changing, and also what? Work ethics. So ethics, companies are nowadays embracing ethics. So you find that what? They're employing a lot of what? A lot of ethical principles of ethics. Then process change. So designing workflow or procedures to enhance productivity and quality. This is very true. The second process means what? There's a process of, like for example, even the process of applying for an ID in Kenya. There's a way it used to be done. Process of applying for passport. If you look at the way it used to be done in 1960, 70, and now it's different. So that means what? Because of the technology, this what? Of course, nowadays used to use what? E-citizen. Traditionally, maybe there was no digital way of doing it. And then you have what's called what? The people-centric change. These are basically change that happens in people and also affect the company. So talk about change in employee roles. The roles are changing. Skills development are changing. New employees are acquiring more skills. Or leadership approach to adapt to modern working. So basically, you need to change your skills. You need to build your skills. You need to ensure that you have a good leadership style, and also you need to ensure that you have a good approach that's able to help you manage a modern employee. This Gen Z and the new people is very important that you look at that. So our brother had requested for a prayer break at this time. So I'm requesting the rest. You can take a glass of water. Then we meet here at exactly 7. We are taking a 10 minutes break, and by 7 should be back here. Thank you very much. Let's have a small break. Then we come back to continue this question. We are back. Please confirm if you're back. Confirm. If you're back, confirm so we can proceed. Good, I can see people responding. That means we can see a good response. Buchi Aziz Orangi, back. So I believe everybody else is back. So the next question here is asking, analyze 5 challenges associated with delegation. Delegation basically means giving some activities to be carried out by a junior. When you are giving your junior some work that is supposed to do on your behalf, that is called delegation. So this question is asking us challenges of delegation, or sometimes reasons why some people would not want to delegate, call them challenges, or why would somebody say that delegation has got the following problems. So what are some of the challenges you are likely to face in delegation? Number one is lack of trust. Sometimes we don't delegate duties to our junior because what? We don't trust them that they're able to do the work the way it's required. So if you don't trust, if you don't have 100% trust that your junior can do the work, then basically delegation becomes very, very difficult because you're doubting them. So managers may say to delegate tasks to their due to fear of what? Subordinates may not perform adequately. When you fear that the junior member of staff may not be able to do the work well, then basically it is a need for it's a case for what? For fear. So number one is lack of trust. Number two is what? Inadequate training. So that employees may lack adequate lack necessary skills or knowledge due to what? For performance of the data. So basically, when you talk about training, maybe the junior employees are not well trained on how to carry out the delegated tasks. So they may end up doing the work in a very shoddy manner. That's why we say that you can delegate activities or duties, but you can never delegate responsibility. That's why if you believe that your juniors are not competent enough, then basically it's better you don't delegate, because if something goes wrong, you will be blamed, not the junior member of staff. Then number 3 is fear of loss of control. This is also a very important, a very major challenge. Sometimes, if I'm the senior person, I fear that if I delegate, I'm giving a hypothetical example. If maybe Ngetich is my junior and I'm the senior. Now, there's a fear that if I delegate duty to Ngetich may outperform me. When Ngetich outperforms me, the management or the senior people may believe that what I was not doing enough. So sometimes you may delegate work to some junior and then he outperforms you, and then it looks like what you're not doing the work well. So that some managers feel they will lose authority or become less relevant if they delegate important tasks. Sometimes, some managers feel like what because they do those important tasks, they're very important. So if they delegate, then basically the importance for the company goes down. That is one thing that they also feel. Number 4 is unclear communication. So without clear defined expectations and instructions, delegated tasks may be misunderstood or executed incorrectly. So there's something called information. Anytime you are delegating tasks, giving somebody a task or you're delegating tasks, you must first explain to the party what you expect them to do. You must let them know the do's and the don'ts so that they don't what? They don't start guessing. You must know that what? This is what you're supposed to do in this work and this one don't do. So basically, sometimes we delegate tasks and then we don't tell the employees what, or we don't tell the junior staff what to do. So they start guessing what they think they should be done. So basically, in delegation, ensure that you tell them the expectation that I'm giving you this work, do A, B, C, D, and report back to me. So that's very important to look at that. And then number 5 is accountability issues. That even when tasks are delegated, the managers remains accountable for results, leading to what? Reluctance to delegate critical assignments. So we talked about responsibility or accountability. Means as a manager, even if you delegate a task to somebody, let's say for example, Ngetich is my manager. If Ngetich delegates duty to me, and then I do them wrongly, Ngetich will still bear maximum responsibility and he is accountable for the wrong deeds that I've done. You delegate tasks, but not responsibility or what? Accountability will be here. So for me to, because I can give work for my junior and then he does it badly, and then in case something goes wrong, even in court, I can be the one being held up, being taken to court, not my junior, because I was supposed to do the work. I am the one who delegated the duty to the junior, and I didn't confirm their competence first. I didn't determine their competence first. I just gave them, and then did it wrong. That's very important. That's why even in critical sectors like hospital, even if you are still being trained to be a nurse or a doctor, there's normally a supervisor, an experienced doctor or nurse that works with you. So that what? And they're normally told that this attachee is your responsibility. So ensure that whatever they do, you monitor. So those ones happen in critical areas, even in the aviation industry, pilots basically. Before you can be allowed to fly alone, you are normally given an experienced pilot to be taking you until you gain enough flying hours before you can out, so that you can now do the work at least independently. So those ones. So talk about what? Accountability issues means what? The person who delegates the task is still accountable for the task, even if the junior does it wrongly. So that's another challenge in our delegation. So I hope that is understood, those challenges understood. Question number 3, A is asking, in relation to the statement, which statement was that? I think there's something that I left. There's something that I left here. In this question, I don't know if there's somebody with the past paper. So this question, I'll jump it. Somebody write somewhere, write this question, I'm jumping it because write the question on the page, because I know there's a statement, and from that statement, I'm supposed to answer this question. So since I left out the statement, it's going to be very difficult for us to know. But there's no problem. The question just asks about, so you can still answer it basically. Talk about what? Explain some of the characteristics of a group. Also, this question basically asks about what? The features of a group. But if you get the papers, then you can say, what I'll share the papers. Not the one which is not, I'll share the normal papers. These ones are basically the white papers, but we also have normal papers. I don't know if you can send the link. Did I share the link with you? Did I share the link where you can get the papers? Did I share the link? Now you're back. So this question is asking about what features of a group. What are some of the characteristics that what a group has? Number one is common goal. So basically, if you work as a group, then basically you must have a common goal. If people have got different goals in a group, then basically that's not a group. A group must ensure that we have a common, like a team, a football team or a whichever team. You do different things, but all of you work towards what? Achieving a win. So that group are formed. Groups are formed with a shared purpose or objective that unites members and drives collaboration. So even a group or a team must be people that what have a common goal. There's a goal that they want to achieve what in commonly. Then the next one is interaction. Interaction is very important. That's because you are a group. Somebody has written something here. Which one? The question. Group formation. Group decision making. We are done it. Even group decision making. So basically, I'm not really, I don't know the specific topic, but I know we are done aspect of groups. So if you check the notes, you should be able to see group. Very important that you understand the concepts there very, very well. Now the next one is the next question is asking group norms. There should be a norm. A norm is basically rules that govern the group. You see, anytime you have more than one person in a given situation, you must know that what? There must be some regulations. It happens. There must be some regulations. If you don't do that, then you'll end up what? You'll end up having everybody behaving the way they want. So for a group to move on well, there must be some regulation. There must be regulations put in place to ensure that what the group functions. So anytime we talk about a group, there must be regulations to govern the group. So we talk about group norms. So informal rules and standards guides how members behave in the group. So basically, that is very true. You must ensure that what in a group, there is a way in which people are supposed to behave. So it can be formally or informally. Anytime we talk about group, when we talk about aspect of informal group, you and your friends, that is an informal group basically, whereby you interact. But even in that group where you're interacting, we don't write down rules that this is how we want to behave. But automatically in a group, you try to what? You try to behave a little bit better. So that what you don't go to an extent of what? Of making other members feel embarrassed, or you don't bring in harmony in the group. So that is very, very important. So we talk about what aspect of group norms. So talk about informal rules. Informal means what? They are not set down. If you're a group of your friends, you don't set rules, but basically there's a standard way of behavior that what should be able to have. So talk about informal rules and standards guide how members behave within what the group. Then part is what? Rules, roles, and status. So each group members may have a specific role or status that defines the responsibility and portion. This is very true. When we talk about aspect of what? Aspect of members. Sometimes the group we allocate duties and responsibilities. So you know that you're the group treasurer, you are the chairperson, you are the team leader, you are the sergeant at arms. So basically, sometimes we talk about what the roles given to each group member, and also what the responsibilities. Like if you look at a group, I've got a team basically. Like in a team football team is an example, a good example of a group could be a team, a football team or an airfield. I know there could be people here that are not into football, but I'm talking about just a team. A team, if you have a team has got what? Different people doing different things. You have the goalkeeper, we have the defenders, you have the midfielders, we have the attackers. All of them do different things, but at the end of the day, they want to ensure that what at least they're all. There's a role of a goalkeeper, role of a defender, role of a midfielder, role of a striker. So basically, they do different things, but at the end of the day, they must ensure that what they help the group achieve it all, achieve its objective. Very, very important that you look at that perspective very well. The next question is asking. The next question here asks, examine 3 assumptions of Maslow hierarchy of needs. This one we did. We call them theories of management or theories of motivation. You can call them theories of management or theories of motivation. So you're told about 3 assumptions. This guy called Abraham Maslow said that what needs of the human beings are classified from the basic needs all the way to what? To self-actualization. So in doing this, in coming up with these needs, which are normally classified and ranked, there are some assumptions that he was able to say that these some of the assumptions that researchers found that he assumed, or him himself in coming up with that theory, he was able to say that these some of the assumptions to this theory. Now, number one is Maslow believed that needs are hierarchical, means lead follow one another. So, like for example, we said that the first needs are called physiological needs. That means what? Needs for clothing, shelter, and food. Then after that one, then go to what? Safety needs, security, both job security and physical security. Then social needs, then self-esteem needs, then actualization at the top. So basically, according to him, said that what these needs are hierarchical, means what they are ranked, the first, second, third, until the best, the highest need. But in real life, those needs may not be classified like that one. Sometimes you may be in need of two needs at the same time. You need physiological need at what and safety needs at the same time. So basically, they're not ranked in that case. So that human needs follow a specific order: lower physiological and higher level self-regulation. And lower needs must be satisfied. So according to him, he said that what needs must be satisfied what in that order from the lower needs to the middle. But in this sense, that could not be. That's not the case. Sometimes needs can come even there. Some needs you can have needs which cut across the levels at the same time or in one time. Number two, he said that what satisfied needs do not motivate. So according to Abraham Maslow, he said that once a need has been satisfied, then basically it doesn't become a motivation. It was like he's saying that if you're full, if you've eaten and you're full, then food does not become a motivation anymore. Ukishakula umeshiba, then basically food does not motivate you anymore. But the question is, do you get full forever? You get hungry and buy and get food at the end. So basically that one will apply. That's what he said that once a need has been satisfied, then basically it doesn't become motivation. Now, for example, money. Even those who have excess money still need money. So the question is, if you have like, you are worth $10 million, you multiply with the Kenyan money, that's a lot of money. But you still look for money. The question is why? That is money that even if you sit down, you can still live very good life daily until you die without spending any energy working. But why do you look? So basically that one. And number three is what? Everyone has the same needs. So according to Abraham Maslow, that what? Everybody in this world, we have the same needs, which means not the same. People have got different needs, even motivation. That's very true. If you happen to read widely and look what is considered success in some countries, basically, now, he said that everyone has the same needs. Now, I was trying to give an example that in some countries, success is not determined by how much money you have. They look at the service you offer. So in some countries, however much money you have, when people talk about respect, what have you used for that to do? What have you done with that money? That is basically what concerns them, not like you have the most rich. They don't even recognize you. They may recognize somebody with lesser money and has been able to what? Do something to the society. But in the African setup, about money. The more money you have, the more power you have, the more recognized you are. Even in funerals, how much did you contribute? That is what matters. In schools, that's what matters. How much money do you have? In the family, how much money do you have? So that if a younger brother has more money than everybody, the respect is transferred from any other person to the younger brother. You even see some seniors stand up in the seat. Firstborn anaamka kwa kiti, mdogo akae kwa sababu mdogo kuna pesa, which is very unethical. But basically, in Africa, money is what we are worshiping. And we end up dying without what? Getting enough money. So there's something called self-satisfaction. This satisfy what you have, but work hard to be able to what? Get something that can take care of you and the people close to you and some people that you can help, basically. But amassing them and stacking them so that you want to be called a billionaire without helping, you may end up dying without using the money. That's how nature is made that way. There's always balance of nature. When you take money from the poor and stack it somewhere, something is going to happen that's going to bring that back, that money. Either you have a sick person, take the hospital, going to kill you, eat your millions, and then money come back to the economy. So basically, right. So I was talking about that one. That's everybody has the same need. So if you look at some people work hard for the money as a need, some people work hard for some other things. So basically, there's no universal need for everybody. Although we need the basic needs are very important, but now other needs may not be the same. So those are some of the assumption of what of Maslow. Those are some of the things that he assumed in coming up with this theory. So these are some of, we can call them what prisms of this theory. The next question is saying, explain 3 information roles of manager according to Miss Berg managerial theory. So Miss Berg was able to classify management roles, I think, into 3 categories. So I think it's 3 or 5 category. And the first, the one category was what? Talk about information roles for manager. What are the 3 information roles for manager? Basically, number 1 is monitor role. A manager is supposed to what? Is supposed to collect, analyze information from both internal and also what? To stay updated on what environment. So basically, as a manager, you must collect both internal information in the company and external information, and then analyze them to help you what? Make a proper decision for the company. Number 2 is what? Disseminator role. So that information you are collecting from the environment, both internal and external, is not for only you. You're supposed to pass it. Dissemination is what? You're passing that information to other people. So you're supposed to, sometimes you go for these meetings, these top level meetings you discuss. The training or the idea you have come up with, you are supposed to disseminate, let other people know what you've discussed. That can help the company. So that the manager shares relevant information with the team members to ensure everyone is informed and aligned with organizational goals. You're supposed to disseminate any relevant information that you think can help the team, then basically disseminate it, pass it to other people. And then number 3 is what? Spokesperson's role. As a manager also, you are the spokesperson of the company. If something goes wrong in a given company, you just where is the manager? Where is the CEO of this company? Mkubwa ni nani? That means what? Sometimes as a manager, when the company needs to pass some information, it will be upon you to pass that information. So that is called what? Informational role of a manager. As a manager, you are supposed to pass information to the people concerned or to your juniors. So those are the 3 information roles of manager according to Miss Berg management theory. So Miss Berg was able, or Masberg was able to categorize the roles. So he was able to group the roles. The group roles, very, very important. So he was able to group the roles. So he was able to get them and group them. That is basically what so he wanted to pass. Then the next question. The next question is asking question 4A. Say that state 5 principles of task specialization as proposed by Max Weber in his theory of bureaucracy. See, Max Weber is coming up again. So principles of what? Of task special. So Max Weber advocated that what? People should do what they're specialized in. That's called task specialization. You must do what you're specialized in. If you've done accounting, do accounting work. If you've done procurement, do procurement work. So Max Weber was advocating that what? People should be put in areas that they are conversant with and or areas that they have information or knowledge in. That is what Max Weber was advocating for. That is what Max Weber was advocating for. Max Weber. Now let's look at the theory. So what are some of the principles of this task reviewed by Max Weber? Number one is division of labor. Max Weber said that don't let somebody do work from the start to the end. Divide labor so that somebody do that a part of the work, other person picks, so that the work is done in piecemeal. Accountant wafanye kazi yao ya accounting, accountant do their work in accounting, procurement people let them do procurement work, sales and marketing. So let's divide. So tasks are clearly defined and divided among individuals based on specialization, area of specialization, promoting efficiency and experts. So if you're accountant, then accounting, and doing accounting work, you're very efficient. But if I've done procurement and then I'm put in accounting work, then basically I start guessing and I end up messing up the company. Number two is what? Hierarchy of authority. So a structured chain of command exists where each position is supervised by a higher level, ensuring order and account. So you also said, I talked about what hierarchy, that there must be an order in terms of authority. Who is the senior most, followed by you until junior, and the aspect of what? Of passing information or authority. Number three is about formal rules and regulations. So a set of standardized rules govern operations and decision making to ensure uniformity and control. So it's also what? Max Weber also advocated for what? Like that you should be able to what? Have rules and regulations that what? Everybody behaves uniformly. If we have rules that govern a given, for example, we have something called the Public Procurement and Asset Disposal Act of 2015. That document basically controls all procurement officers in public sector, whether you're in the parastatal, in the county government, national. So that means what? There should be a uniform behavior of procurement officer, irrespective of the department, of the parastatal, or of the public institution you are in. So basically, look at that. Then number four is what? Impersonality. So tasks and decisions are performed without personal involvement or resume, ensuring objectivity and fairness. So Max Weber also said that what? Anytime you're given a job to do, be in person. Means what? Don't do a job, look at the benefit you get from it. Or like, for example, if I'm doing procurement, then I say that, okay, I talk to a supplier, when transportation, I'll give this 10, and then what? Give me a kickback of 10%. That is as well, that's conflict of interest. So basically, say that what? Say that tasks and decisions are performed without personal involvement or you don't favor, ensuring objectivity and fairness. And then number five is employment based on technical competence. So if you want to employ somebody, look at, are they technically able to carry out the task well? So that recruitment and promotion are based on qualification. So if I want to employ somebody, or I want to recruit somebody, I want to promote somebody, I must look at number one. What is your qualification? What is your experience? And merit rather than what? Personal connection means, personal connection means what? You employ somebody because it is from your tribe. You employ somebody because it's a family member. You employ a person because of your friend. You are subjective. You look at other factors. Being a friend doesn't qualify you to get a job for me. Being a relative is not a qualification of getting a job. If you're going to be my relative, then compete with everybody. If you're the best amongst them, then I choose you. So I can even support. I can justify your inclusion. Sometimes, you see, if my brother applies for a job and is the best among the people, that's how I apply for a job. So should I deny my brother a job because he's my brother? But in case I'm being questioned, can I justify why my brother got the job? If people are doubting me, then basically what do? I can excuse myself. I can declare confidence that what among the candidates being interviewed here, I have my brother is amongst them, or I have a kin here. You don't say your brother. You see your brother, your sister, you're narrowing down. You say, I have a kin here. I have a relative that is what is coming for the interview, so that you don't know whether it's a male or a female. So because of that, I'm not going to be part of this interview panel. So you excuse yourself so that, and if he still wins, still get the job, then basically you didn't have any influence. But what normally happens in this kind of arrangements is that CEO knows that his brother is there, or his sister, or the sister to the wife is there. Then it comes and say, I'm giving hypothetical example. Don't take offense in it. I'm just giving you a practical, a hypothetical example. So let's say, for example, the person being the CEO, Ambuche is the CEO's brother. So the CEO goes to the panel. When they're about to task this, that no, I'm not going to be part of this panel of selection because I have a brother here called Ambuche Gilbert. And because of that, I cannot be part of this discussion or selection panel. I think that's a very bad thing because first, he has named the person that Ambuche Gilbert is his brother. That is a communication. He's saying that I'm leaving, but ensure my brother gets the job. You know that? Because the question is, CEO is the topmost in the hierarchy of management. You are a junior person from the HR office. Will you deny Ambuche a job? As that Ambuche didn't get a job. So basically, it's problematic. So don't name. Just tell I have a king coming for the interview, so I cannot be here. But don't, if you want to name Ambuche, then you start thinking, when Ambuche comes to the panel, then all of us are saying that, hey, this CEO's brother, bro. We have to give this guy a job. If you don't give this guy a job, we're in trouble. So you don't name somebody, just say that what? I have a king who's coming for the interview, so I want to be part of it. I've seen some people reading some here. Somebody saying something here. Let me get the question. It's conflict of interest, basically. It's conflict of interest. So that's what happens. Even in tendering, tendering, basically, it just happens in tendering, where somebody says that what? My wife is among the people that bid for the tender. Tender number, or maybe give some the name of the company. Say that Cauldron Solutions belong to my wife, so cannot be part of what? This tender evaluation committee. That means he has told you that he's leaving but take care of Cauldron Solution because that is his wife's company. So those are how they were. That's how they would operate. While the CEO said that the wife has a tender as a Cauldron is this wife, the CEO's company, wife's company. Wewe ni nani utakataza CEO? Even if he says he has a kin coming, the second name will be automatic to fill the question. Basically, if they're using they're using maybe what we call the family name, then basically you see the family. So those things happen. Basically, those things happen. In work at the work environment here, you see those things happen. Sometimes that's why some people go for the interview and say that it's a formality. Especially anybody here works is there anybody here works at the county government? Anybody here works at the county government? I want to talk bad about county government, so I need to confirm if somebody's here, so I don't talk bad about the county government. But I believe the county government is the worst employer. I don't know. I have my reservations, but I believe that county governments are the worst employers. I don't know why I have that perception is that first, incompetence. Incompetence is paramount in county governments. People cannot even read. But don't take it personal. If you are in the county government, you have got employed there, please. I'm just giving an opinion. Opinion is everybody's opinion, so don't take it personal. Now, in the county government, is the worst employer. First, there's no merit-based recruitment. There's no merit at all. Positions are being taken at the table level. Employee directors are governor, tech two, speaker, another one, the county, the county senator, two, the women rep, one. They are divided like that. So when you go for the interview, you from Nairobi here say that, oh, I've seen a good position in the county government, let me apply. I'm telling you, you are not going to get it. Yes, that's how it happens. I have people here understand these things. But now I'm not sure they understand these things. So that's why sometimes in this life you don't need to be in this life. Don't try to look for so many. Don't try to look for so much knowledge. You'll get stressed out. Hey, don't think too much. Just believe. Be a danda. If you're danda, you live so long. But if you are critical, you can commit suicide. Because you ask yourself, how will I get employed? So in this country, stop thinking too much. live within life, whatever you need. But if you're not thinking that I'm qualified, I can get a job, you're going to stress and leave them. And they're still going to laugh all the way to whenever they're going. So basically, be stupid, try what you're doing, and forget about something. Don't be so much optimistic. Eh? Don't live so much on hope. Eh? Now, the next question here is, describe 5 factors that to consider during strategic analysis of internal environment the company. So what factors do you consider during strategic? We are not talking about just analysis, talk about what? Strategic analysis of internal environment of the company. Factors, we talk them what? We talk about internal environmental factors that we look at. Number one, somebody has written something. Let me check on the, can see something popping up. I jumped the question. Oh, sorry. Okay, thank you very much for that. Let me go back to the question. Sorry. So highlight 5 factors that should be considered by an institution when developing what? Its structure. If you want to come up with a company structure, organizational structure, what factor do you consider? Number one is what? The size of the organization, basically. There's some structure that way. If you have a small company, then the structure will be maybe one level. You are the manager and you are the sole proprietor, basically. So the bigger the company, the more complex the structure becomes. So that large institutions may require complex structures while matching with multiple departments, while smaller ones can operate with simpler framework. You can be an accountant, a procurement officer. If your company is just starting, you can be an accountant, a procurement officer, market at the same time. But if the company becomes bigger, then basically you need what? People in those areas. Number 2 is what? Nature factor. What do you do in that company? Which are the activities that are involved here? So the type of product or service offered influence whether a functional product-based or matrix structure is mostly. So basically, depending on what you do, you can decide whether you go for a functional structure where you have departments, or you can go for what? A product-based culture where you have a product line, and then also matrix where you have a mix of what? Or process and product-based functional structure. Then number 3 is what? Technology use. So that the level and type of technology adopted may necessitate what? Specialized department or roles within the company. Technology is very important, basically. And technology has been able to collapse. Most of the vertical company structure have been collapsed by technology. So nowadays you can communicate through. That's why you see even in some of the WhatsApp groups, you find that even the Dean School of Business, we're in a business department, university, you find that HOD is there, the dean is there, and lecturers are there, senior lecturers. So basically means, and if we discuss an issue in that department or in that WhatsApp group, means we are passing, the levels are passing. But if there's no structure, that means what? But if we didn't have a WhatsApp group, if I want to talk to, I want to discuss an issue that touches on the DVC, then basically I have to go through the HOD and all those things to the formal structure. So then number 4 is what? Geographical spread. That's very true, basically. How far you are from one another determines the structure you will develop. So organizations operating in multiple regions may require decentralized or divisional structures to manage operations. So if you have maybe we have a if maybe we have just a minute. So I was talking about geographical spread means sometimes when the company is spread into a bigger geographical area, then basically there's some structure you cannot use. So if you have another branch in Uganda, Zimbabwe, Egypt, then basically you cannot go forward. You cannot go for let's say functional structure. You can go forward for maybe divisional structure. Then organizational culture and leadership style, basically the culture you have as a company, and then leadership style. Is it democratic? Is it autocratic? Is it laissez-faire? Is it transformational? So basically, those are determined. Because if you are a transformational leader or a democratic leader, basically you want a more condensed leadership structure, not a one with a lot of hierarchy, because you want people to get to know you, discuss issue with you without any barrier. So the dominant value and leadership approach determines whether a more hierarchical or flexible structure is applicable. So transformational leadership style, normally the ones what's called what a more flexible structure, whereby people are able to what? People are able to discuss issues in the open without basically bringing any problem or without any barrier. Next question here is asking. Next question is asking. Describe factors that consider during what analysis of the internal relational environment. This question is basically ask you to explain some of what these internal factors of the company. Number one, somebody is reading something. Let me see. Of course, we have other factors. We have other factors that affects. We have other factors. Aziz is asking, do we have anybody who can bring another factor? Factors which affect five factors that could consider what? Developing a structure. Even the government regulations, basically, there are rules and regulations. Now, there are some things that even when you're forming, you're told that you need to what? You need to have a secretary. So basically, those resource constraints or that resource constraints, right? Yes, even resource constraints. Basically, some structures are very expensive to set up and run. Others are cheaper. So basically, if you have enough resources, you can go for a complex structure. But if you don't have resources, then basically go for a single. So basically, resource constraint, especially financial resource, is another one, and even human resource. They put that double up. He is the procurement office and account at the same time, because what the company cannot be able to what employ two people. So what happens? Somebody is a procurement officer on this side at the same time. Is what? He is the accountant. It happens. They put that double up. They put that double up as what? They put that double up as competence of the staff. Yes, competency could be That one I know. That one I know. The competence of the staff. That means what? There's some stuff that very competent staff members can be able to what? To manage even a bigger staff, or they can even double up. They can do two functions at the same time. But if you have incompetence, then of course and all. So competence type of structure, e.g., so leadership, and then that is structure. That is basically ownership style. When you talk about some leadership and the company, is it a structure or it is ownership style, ownership method? Get it? So leadership, partnership, limited company, does that talk about the ownership style or the structure? Get it? We may be talking about the same thing. Yes, yes, ownership. So thank you, madam. Orang is asking a very good question. Now, the size of the organization refers to number of staff or the number of organization staff branches. You know, we talk about factors that determines the size of the company. One of them is basically the number of staff you have. If you look at, we talk about SMEs. If you look at the definition of SMEs, they even talk about an SME is a company with some number of staff. So basically, the number of staff. Number two is what we call the turnover. Profit turnover determines how much do you make as a company. That one determines basically the size of the company. Geographical coverage. How are you spread? Are you in Nairobi County alone? Are you in metropolitan, that's Nairobi, Kiambu, and Machakos County? Are you countrywide? Are you regional company? Are you a global company? So basically, that one. Somebody is asking me, Mwalimu, just highlight what are types of structure. We have the functional structure. We have the matrix structure. Original structures are quite a number. We have the matrix structure, we have the functional structure, we have the divisional structure, and so on. So the most common one are basically functional division, matrix, and then team-based structure, basically. Yeah. So at least you people know them. So at least I can see you. But in your learning, look at the functional structure, advantage, and the features. Look at divisional structure. Look at the matrix structure, and also what maybe the team structure. Those are the most common ones. So those ones are mainly apply. If you go to those these companies in town here, you find that they have departments. So basically, this is a functional structure whereby you have marketing department, production department, and all those things. So, but in government organizations, basically, your department say what? This is the production unit. This one is marketing unit. Basically, that's now called the additional structure whereby you have like a units. And what? This is the production unit, additional, this is the marketing unit. Then basically those are now what? A little bit more advanced. Any other question? Questions zimekuja mingi sana. Any other question? Any other question? Any other question? So this one just based, I can see some highlighted question. SBUs must be specific business units. Does that what it means? Are they the specific business units? Oh, strategic business units. Are the strategic business units considered a structure? No, it's not a structure. It's not a structure, basically. It is within a structure, but not a structure per se. Cannot be a structure per se, because there's an aspect of what? An aspect of interaction between other departments. So basically, but SBU basically means strategic business unit. Basically means what? These are now. You see, in a business, there's whatever strategic business unit means what? It's an area that's, for example, in uni, school of business or school of law. Do you consider them as what? As a structure? Basically, if you look at the structure of the department, a business department, or we talk about school of business or school of law. These are normally, we call them social sciences. Eh? So you can have a school where we have social sciences, then school of law. But basically, depending on the size of the company, or the size of the university, basically, you can have what? Because even I've seen companies where even the school of business is divided because of the number. So they divide. So if you do the structure of the company, if you do the structure of the university, then basically SBU will be part of what? The structure. You see now, in the setup of university, basically, the departments are like the schools. Yes, department and section, basically. All those are right. Business department, then sections. There you have the law. You can talk about School of Social Sciences, whereby you have the School of Law as a section of the department, and so on. So basically, depends on that. The bigger the university, the more complex the structure is. But if you're drawing it, then basically you'll include all those aspects. So you can be able to what? You can be able to use them as what? A structure. That's an academic institution. So sometimes structures of companies differ because of what? The nature of the business they're doing. Like a university and the production business, or if you are doing manufacturing, basically the structure will vary because of what? The nature of the business they're doing. So they may not have the same structure, but even the naming, maybe you might find that the name they're using is different, but they could mean almost the same thing. So that's a very complex. So they leo tumeenda sana, tumeenda complex sana. That means people understanding. So I would request, because of time, we can stop there. And I want to say that this Saturday we'll be having our last class for this semester. We're going to have a last class for this semester. And I know you're confident now. And I pray that all of you pass exams. And I know you want to pass because the work we have put through in these units, I'm sure that you want to pass. And after exam, some of you will inbox mwalimu ile tu sijui, but let's wait. But I know that one I did well. I know my students, they normally come back to me and tell me, mwalimu, that was a very good paper. So I expect that to be a good paper. So I want to wish you well, but I will be here Saturday, so we can talk about the papers. We can wish ourselves well. can do. I don't do predictions. I don't do prediction. I don't do prediction because once I do something called prediction, then people start concentrating on the prediction when and they may even stop revising other things. And then if those things don't appear, then we have done more harm to you than good. But basically, I can just give you some questions to look at. So that means I said that in addition to what you have in your past papers, also look at this. But I cannot say that these are prediction because I don't want you to start concentrating on something and then you go there and define the question. Then I'll be like Malimuni Ametudangani. So everything we are doing here, we have already predicted our questions and answered some questions that are coming to the exam. Sasa hii ujue kuna maswali mengine ushafanya hapa nazo kwa mtihani. Sasa kuna maswali tumefanya hapa kama maswali kama 5 labda kwa mtihani. So we have predicted well. Yes, that is what I need. Anytime you go to do a professional paper, have an open mind. Know that you can come up with a point and support your points. Don't be just cramming. Right now you have knowledge. Uko na akili ya kufikiria. There are points that I did not give you in the notes, but you can be able to come up with that point and justify it. In CASNEB exams, we mark what we call, does student have a point? Are they able to substantiate it? Can you support your point? If you support it strongly, we give you a tick. Somebody's asking, Wendy, anyone with the CS April sitting, Wendy, that paper, I have sent it to you, Wendy Wangali. Wendy, that paper is in the group. Look at the CS past papers I've sent. And even this combined one. Let me go back. Wendy, najua hii paper tuko nayo hapa. Kwa hizi, you see this one we are doing here. Look at this one. This one is, look at this. Wendy, what is appearing in your screen? Look at the first paper there. Which one is it? Wendy, do you see what is in your screen? That is which one? April 2025. So Wendy, that one tells me that Wendy, you don't look at my past papers. You just meet them in class like we were meeting here. But I know now, from today all the way to Monday, some of you will put your legs in the water. But if you are read well, you will be comforted. But all of you are on to pass. So with those remarks, I want to wish you a good week. Let's meet. If God protects me and protects you, we're going to meet on Saturday and discuss more. And then just wish ourselves well in the exam. And then after the exams, we'll talk and see what happened, what came, what not came. And then we can continue next semester. If God allows us to have a unit with you, I'll be there. But even if I don't have a unit, basically, I'll still be in the institution, we'll discuss. So with those remarks, have a blessed evening. Thank you. Good, Aziz. Oh, you have a good night.
number 1. And the topic is nature and the classification of companies. So as far as this topic is concerned, we said that we are going to discuss a number of issues as far as the company is concerned. 1, we will start by defining what is a company. And then from there, we look on basically the various characteristics or features of the company. And then from there, we look on basically the classification of companies. How do we classify companies? Because generally, we do have different types of companies. We are going to look at those different types of companies. But in this case, I want us to start by defining what is a company. And basically, in this case, when we talk about a company here, this one can be defined to be an association, of persons, which is basically formed for some lawful common purpose and also registered in accordance with the Companies Act of 2015. So therefore, this is what is association of what? Of persons. Association of what? Of persons, which is basically formed for lawful common purpose, and also registered in accordance with the Companies Act of 2015. So that is the definition of a company. So what do you mean by association of persons? Association of persons, basically, this whereby, for example, we may agree to come together and basically we start doing business together. We start doing business together. So therefore, association of persons, this basically whereby we have a number of individuals, 2 or more persons will come together. They agree to register a company in order to undertake some business, which by the end of the day is legal, or basically a business which is what? Lawful. So that is basically the definition of a company. And basically in this case, we are saying that this particular association of persons, by the end of the day, it has to be registered in accordance with the Companies Act of 2015. Because if, for example, today we have agreed maybe to carry on a business, and that business will be conducted in form of a company. So by the end of the day, we must register that company in accordance with the Companies Act of 2015. And I hope you can also be able to recall what we said in our previous class. Previously, companies were registered in accordance with the Companies Act, Companies Act, Cap 486, but this particular act has been scrapped and basically replaced by the new Companies Act, that is Companies Act of 2015. You may come across some old notes which are basically talking of Companies Act Cap 486. So that act has already been repealed. Basically, it has been done away with and replaced by the new Companies Act of 2015. So today, if you to register a company, either a private company, a public company, you must register that company in accordance with the provisions of the Companies Act 2015. Now, this act here, that is the Companies Act of 2015, Companies Act of 2015, basically provides some legal framework, regarding number 1, the formation of the company, formation of the company. How should a company basically be formed? So that is clearly stipulated under the Companies Act of 2015. It also clearly stipulates issues to do with the management of the company. How should the management of the company be, or who should manage the affairs of the company, and how should those particular affairs of the company be managed? That is also something which is clearly stipulated under the Companies Act of 2015. And also we have the aspect of liquidation. So liquidation, remember yesterday I said that liquidation basically is the legal process through which the legal existence of the company is brought to an end. That is also something which is provided for under the Companies Act of 2015. How can a company be liquidated? What are the grounds for liquidating the company? And maybe the various types of the liquidation. Now, in this case, other than the Companies Act, which basically talks about the formation of the company, the management of the company, the liquidation of the company. So we also have various, or basically we have case law, or we have various case law. In this case, when we talk about case law, this in other terms we refer to it as the judicial precedent. So what do you mean by the judicial precedent? The judicial precedent, basically, these are those particular rules. Or principles, which the judges will come up with. After basically deciding various cases. So mean that other than the formation of the company, the company's management, and also liquidation being governed by the provisions of the Companies Act, we also have various rules and also principles which have been formulated by the judges, also which basically provide some legal provisions regarding the formation, management, and also the liquidation of what of the company. Therefore, we say that in different topics, we will basically come across various rules or basically various principles which have been formulated by judges and which basically governs the aspect of forming the company, management of the company, and also the liquidation of what of the company. But majorly, most of the provisions regarding the formation of the company, regarding management, and also regarding the liquidation of the company, they are basically contained under the Companies Act of 2015. And therefore, most of the things we will discuss in this unit here, they are purely contained in the Companies Act of 2015. Now, in this case, we can proceed and look on what are the features or basically what are the characteristics of the company. So let's look on the features. Take into account, we have already defined what is a company. We look on the features or basically the characteristics of a company. What are the features or basically what are the characteristics of the company? Number one, we can talk about something called the separate legal personality. The separate legal personality. Separate legal personality. So basically what this means is that once, for example, you come together and maybe you have registered a company with the registrar of companies, that company becomes a legal entity, which is separate and also distinct from its members and also its directors. So once a company has been registered here with the person called the registrar of companies, in this case, we say that there exists a kind of a shell or basically a kind of a shield which basically separates this company from its members and also its director. So what that means is that if today we have agreed to register a company, once that company has been registered with the registrar of companies, the company becomes a legal entity. That's why you see that a company is legally recognized to be having the same status just like you. So if you register a company today, that company has to pay tax to the government just like you. That company has the capacity to enter into a contract just like you. So once, or basically what that means is that once a company has been registered, once the company has been formed, a company becomes a legal entity, separate and also distinct from its members and also from its director. So a company is not the same with sole proprietorship business, because if today you form a sole proprietorship business, that business is basically viewed to be the same with the owner. So if, for example, we come together, we form a partnership business, that partnership business is not separate from us as the partners. So that's why you see that if the partnership business is not able to pay its debt, the partners must come in and know how those particular debts will be paid. But in case of a company, if we register a company today, a company has that aspect of the separate legal personality. If the company is not able to pay its debt, those are not our debts as the members. So if the company has maybe entered into a contract, that is not our contract. If the company has some assets, are those our assets? No. So therefore, that is one of the characteristics or basically one of the features of the company. Number two, we say that the company has something called the limited liability. The limited liability. Limited liability basically means that if, for example, the company is not able to pay its debts, and then the members of the company will not be required to come in and do what? Contribute money to pay the debts of the company. So in other terms, this means that the liability of members in a company is what? Is basically limited. Is actually what? Limited. So if the company is not able to pay the debt, then the members do not have any responsibility as far as the payment of those particular debts of the company are concerned. In other terms, we can say the debt of the company are not the debt of who? Of the members. So the members cannot be called upon to come in, contribute money to pay what? To pay the debt of what? To pay the debt of the company. So the other feature, or basically the other characteristic of the company, is something called number two. Also number three, that is number three, we have what? We have perpetual succession. Perpetual succession. Perpetual succession, or basically you can refer to this as permanent existence. Permanent existence. Permanent existence. What does this mean? Permanent existence. It basically means that once a company has been registered, a company or the life of the company is continuous. Because when we talk about something or continuous, this is another name for, sorry, perpetual is another name for continuous. The life of the company is continuous. The life of the company is continuous, or basically the life of the company is what? Perpetual. What this means is that if, for example, something happened to a member, or basically then a number of members, that do not in any way affect the company. That do not in any way affect what? the company. A company cannot be liquidated because maybe something has happened to a member. For example, maybe one of the member has died, or maybe one of the member has exited the company, No. So the life of the company is continuous. So once the company is formed, even if, for example, some of the members exit, some of the members are declared bankrupt, some of the members die and they leave the company, that do not in any way affect the life of what? Of the company. It's not like a sole proprietorship business, whereby if the owner dies, that can lead now to the closure of that what? Business. Equally, like what happened in case of partnership. If maybe one of the partner dies, one of the partner maybe retires, that can lead to the dissolution of a partnership. That is not the case when it comes to the company. The life of the company here we are saying is what? Is continuous. So if a member exit or something happened to the member, that do not in any way affect what? The life of what? Of the company. Number 4, we can say the company has got something called the common seal. Common seal. So when talk about the common seal, this is basically equivalent to the company seal. By saying that the company has got a company seal or a common seal, it basically means that the company has the capacity to sign its documents, to sign its what? Its document, to sign its what? Its document. So for any legal document to be deemed to be authentic, that document must be having a company seal. So therefore, a company has a common seal. The company, or that means that the company has the capacity to sign its own document. And take into account the company itself does not have, or basically the company do not have that ability to sign, to sign the document. Any document of the company, for it to be authentic, we are saying it must be having what? A common seal. A common what? A seal, or a company seal. So the other feature of basically the company number 5, we can say that the company has the contractual capacity. The company has got contractual capacity. Contractual capacity basically is the ability to enter into contract. The ability to enter into contract. The ability to enter into what? Into contract. The company has the capacity to enter into contract. But basically, those contracts which are entered into by the company, are they entered into by the company itself? No. So any contract which is entered into by the company is entered into by its directors. By its who? By its directors. By its directors. So the directors are the ones who enter into contract on company's behalf. But by the end of the day, those are contract of the company. They are not contract of directors, because the directors here were acting as the agent of the company. They were acting as what? As the agent of the company. They were acting as the agent of what? They were acting as the agent of the company. So number 6, we can say the company can sue or be what? Or be sued. The company can sue or be sued. It basically means that the company here can go to a court of law, take a legal action on behalf of, or basically take a legal action against a third party. And generally, the company here, or the person who will be going to a court of law to take that legal action, is basically like the management, the directors, or maybe the company's lawyer instituting a legal action on company's behalf. The company can sue in a court of law or can be sued in a court of law. So number 7, we can say here, the company has capacity to own property. Capacity to own what? To own property. The company has got the capacity to do what? To own a property. So just like a natural person, the company has the ability, has the capacity to own the property. In fact, those particular property, those particular assets which are in a company, they are not assets of the members. They are basically what? They are basically the property or asset of the company. Simply, in this case, we have said that there is that aspect of the separate legal personality. If we have come together, we have formed a company. Those assets which exist in that company, those property which exist in that company, they are not our own asset, but basically they are assets of who? Of the company. So then the other feature of the company we can say is there's something called voluntary association. Voluntary what? Association. Voluntary association. So in this case, a company here, remember by definition, you have said is an association of persons. Association of persons. That association is voluntary. You can't be forced to be a member of a company. It's a voluntary. You must voluntarily accept to be what? Maybe to be a member of a company. You can't be forced. You can't be what? You can't be forced. The other feature of the company, number 9, is basically something called the transferability. transferability of interest, transferability of what? Of interest. When talk about the transferability of interest, it basically means that the interest in a company can be transferred. And how is your interest, or basically what is your interest in a company? Your interest in a company is basically measured in terms of the value of the shares you hold in a company. Once you are a member in a company, you have some interest, and your interest is equivalent to the shares you hold in a particular company. You can be able to transfer your interest. You can be able to transfer your shares. Though in some companies, like in private companies, the transfer of the shares is restricted. The transfer of shares is what? Is restricted. So restricted in the sense that you cannot be able to transfer your shares just to any other person. Just to any other person. You wake up today and maybe you decide that you'll sell your shares to any other person. There is some restrictions in relation to that. For example, in a private company, the requirement is that if you want to transfer or you want to sell your shares, you can only sell those shares to the existing members. You cannot sell the shares just to any other person. So the shares can only be transferred to the existing members. But basically, we are saying that there is that transferability of interest. You can be able to transfer your shares in a company. So the other feature of the company, maybe number 10, we can talk over the aspect of management. The aspect of management. So who manage the company in this case? Who manage the company? So the companies basically are managed by an organ which is known as the board of directors. These are basically a feature which applies to all companies, that companies are managed by a board of directors. By a board of what? A board of directors. By a board of what? A board of directors. This board of directors basically comprises of directors who are elected by the members to be in charge of or basically to manage the affairs of what? To manage the affairs of what? Of the company. So therefore, this basically, among others, are some of the features or basically some of the characteristics of a company. Some of the features or characteristics of what? Of the company. So basically what that means that if you go to different companies, you'll be able to see those particular features. So those features applies to various companies. So now, next, I want us to look on the classification of companies. Or basically, we look on the different types of companies which we have. Classification of companies. Classification of companies. And I hope you're together up to that point. Are we together up to that point? Are we together up to that point? Are we together up to that point? Catherine, are we together? Steven, are we together up to that point? Yes. Yes, so we are together up to that particular point there. Can see someone is having a question here. Yes, so I think we're going to discuss on that case of salmon versus salmon, maybe somewhere. Catherine, we're going to talk about the case of salmon versus salmon and the company limited. Almost at the end, there is somewhere we're going to look on the doctrine of separate legal personality in details, almost at the end of this topic. So we will discuss more on that. Okay, so classification of companies. Now here, we have various ways in terms of how companies are classified. Various ways in terms of how companies are what? Are classified. Various ways in terms of how companies are classified, or in other terms, we can say we have different types of companies. We have different types of companies. So number one, we have the statutory corporations. Statutory corporations, or in other terms, these are known as the parastatos. So what do you mean by the statutory corporations or parastatos? So these are those companies which are basically formed pursuant to a certain act of parliament, or in accordance with a certain act of parliament, for them to be able to provide some essential services to the members of the public. And these companies here, usually they are under the control of the government, or they fall under the public sector. They fall under the public what? Sector. Public sector entities are those entities which are basically established to provide essential services to the members of the public. And on the other hand, they do not operate with an objective of making what? A profit. So therefore, these are those companies which are formed in accordance with a certain act of what? Of parliament. A good example of this is 𝐎𝐍𝐋𝐈𝐍𝐄. A good example of this is 𝐎�𝐋𝐈𝐍𝐄. If you do some research, you'll be able to see that 𝐎�𝐋𝐈𝐍𝐄 is a statutory corporation which is formed in accordance with the Accountant Act, which is formed in accordance with the Accountant Act. Accountant Act. Now, on the other hand, we have seen that these particular entities are basically formed to provide essential services to the members of the public, meaning that these particular entities, these companies are not formed with an objective of making profit. With an objective of making what? With an objective of making profit. And therefore, these particular entities will basically continue operating even if they are making losses. They are making losses because we are saying that their main objective is to provide some essential services to the members of the public. Now, in case they make any profit, that profit may be plowed back, may be reinvested back, or that particular profit may be paid to the government as dividends. Remember, these entities are under the control of the government. So if there's some of the parastatals basically make good profit, and basically what they do, they pay part of the profit they are making to the government as what? As dividend. So we are saying the profit they are making can be plowed back, can be reinvested back, or can actually be paid to the government in form of what? In form of dividends. So how is their capital raised? How do these parastatals raise their capital? These parastatals basically raise their capital through borrowing, and basically that borrowing is guaranteed by the treasury. So the government or the treasury is actually the guarantor. In case these parastatals are not able to repay back the amount of capital they had borrowed, who is supposed to pay that capital is automatically the government. So then from there we have the other type of company, and that is basically the registered. In other terms, you also refer to this as incorporated companies. Incorporated what? Companies. Now, when we talk about the incorporated companies, incorporated or the registered companies, number one, these are those companies which are formed in accordance with the Companies Act of 2015. They are formed in accordance with the Companies Act of 2015, and therefore, like in a private company, the public company, and so on, they are good examples of the registered or the incorporated companies. So these are those particular companies which will be formed and also registered in accordance with the Companies Act of 2015. So after these companies have been registered, after they have been registered with a person called the Registrar of Companies, they will be issued with a certificate of incorporation. They will be issued with a certificate of what? Of incorporation, in which case then these particular companies shall be regarded to be separate legal entities from their members and also from their shareholders, shareholders. And actually, these companies here, their powers and also what they do, that is something which is clearly defined under their constitutions. And basically, these two companies, they have two main types of constitution. The first constitution is known as the Memorandum of Association, and the other constitution is known as what? The Articles of what? Of Association. So in other terms, you can say that they derive their powers from these two constitutions, the Memorandum of Association and also the Articles of what? Of Association. So then from there, we can proceed and look on the other type of companies, number 3, and that is the chartered corporations. Chartered corporations. Now, chartered corporations, these are those particular companies which are basically formed upon being granted a charter, basically by the president. Usually, the companies which fall under this category are universities. Are what? Universities, because basically what we know is that for any university to be able to offer various programs, various certificate, diploma, degree, master programs, it can only be able to do that upon being granted a charter. Upon being granted a charter by who? By the president. By the president, who is basically empowered to do that under something called the Universities Act. The Universities Act, the president is empowered to grant a charter to a university if, for example, the president will be is basically of the opinion that that particular university will basically do what? Help the country in terms of development and promotion of what? Of education. So therefore, these are those particular companies which are basically formed upon being granted a charter by the president, who we have said is empowered to do that under the Universities Act. And I've said good examples of this are what? Are the universities. Are what? The universities. Then from there, we have number four. Number four, we can talk of private companies. We can talk of private companies, or private company basically. Private what? A company. So private company here is actually defined under the Companies Act, because one, a private company has to be formed in accordance with the Companies Act of 2015. And the Companies Act of 2015 defines a private company as what? Or we can say a private company, this is a company which by its articles of association, which by its articles of what? Of association. So when talk about the articles of association of a company, articles of association of the company, this is actually an internal constitution of the company. An internal constitution means that this is a document which contains some rules and regulations regarding how the affairs of the company will be managed, regarding how the internal affairs of the company will be what? Will be managed. So this is defined to be a company which by its articles of association, number one, restrict the right of members to transfer shares. Restrict right of members to transfer what? To transfer shares. So if, for example, you're a member of a private company, your right to transfer shares is usually restricted. So what does that mean? It basically means that if, for example, you want to transfer, or in other terms, to sell your shares, so there is some restrictions as far as that is concerned. And I think I've given a good example that if, in case you want to sell your shares in a private company, you can only be able to sell those particular shares to the existing members. You can't sell those particular shares to just any other person. So number two, we say is a company which by its articles of association limit the number of members to 50, limit the number of members to what? To 50. Limit the number of members to 50. The number of members in a private company cannot exceed 50. And number three, is prohibited from inviting members of public to buy its shares, or in other terms, to subscribe its shares or debentures. So it basically means that in case a private company wants to issue shares, it can only be able to issue shares or even debentures to the existing members. It cannot be able to invite the members of the public to come and buy its shares or debentures. So therefore, this is the definition of a private company. So we have said it's a company which by its articles of association, number one, restricts the right of members to transfer shares, limits the number of members to 50, and number three, it is prohibited from inviting the members of the public to subscribe its shares or debentures. Its shares or what? Or debentures. Now, before we proceed to look on the other company here, we can proceed and look on the other features, or maybe we proceed and look on more features, or basically the various characteristics of this company, because it is important for you to note that this is basically one of the common type of a company, which is basically formed by individuals to do business. In most of the cases, if today you want to register a company as an individual, you will be registering a private company. You'll be registering a private company. This is therefore one of the common type of company. So one of the features of this company, number one, is that private companies have a minimum, or basically in other terms, you can say, must have a minimum of one member and one director. One member and one director. So according to the new Companies Act, or basically according to the Companies Act of 2015, so for this company to be formed private company, it requires a minimum of one. A minimum of one. But the repealed Companies Act, that is Companies Act Cap 486, it was requiring a private company to have a minimum of two members. But today, as an individual, you can register your own company as a single individual. So it requires a minimum of one member and one director. One member and one director. So that is one feature of this private company. So the other feature of the private company, we can say that this company can basically commence business upon incorporation. Incorporation is basically the process through which a company is registered with the registrar of companies. So once this company has been registered with the registrar of companies, remember you have said that the registrar of companies will issue something called the certificate of incorporation. That company can start to operate upon receiving that certificate. But we will be able to see if, for example, you are registering a public company, for that company to start operation, it's required to get another certificate still from the registrar of companies known as a trading certificate. But this company was registered, issued the certificate of incorporation, it can be able to, or it can start, or it can commence business. So the other feature of this company, I think that is something I've mentioned here. It restricts the right to transfer shares. Right to transfer what? Right to transfer shares. So if you are a member of this company, your right to transfer shares is restricted. Now, this restriction for the transfer of shares is achieved in two ways. In other terms, you can say that this restriction regarding the transfer of shares is restricted in two ways. One is through something called director's discretion. Director's discretion. Basically, what this means is that, or basically this document here, that is the Articles of Association, which you have said is an internal constitution. We have said it basically requires that in case you want to transfer your shares, to transfer is basically to sell your shares. So in case you want to transfer your shares in a private company, you must first of all inform the directors of that company. Inform the directors that you want to sell your shares. Now, once you have informed the directors are empowered by this document, by the internal constitution, basically to do what? To decline you, or basically the directors do have that particular power not to give you a permission, or basically a consent to go ahead and basically do what? Sell your shares. They can tell you that you will not sell your shares. You'll not do what? Sell their shares. In other terms, once you have informed them you want to sell your shares, they can decline to register that transfer of shares. So once they have declined to register your transfer of shares, it means that you can't be able to go ahead and you do what? You sell your shares. So that is one way through which the free transfer of shares is restricted. Number two, it is also restricted through something called the pre-exemption clause. Pre-exemption clause. So this is still a clause which is contained in this document, Articles of Association, and which basically requires that in case you want to sell your shares in a private company, you must offer for sale those shares to the existing members. You can't offer for sale those shares to just any other person. This clause requires that you must offer for sale all the shares to who? To the or basically you must offer for sale those particular shares to the existing members of what? Of the company. This particular clause is meant to ensure that in case you are selling your shares in a private company, you are not just selling those shares to any other person, but basically you are selling those shares to who? To the existing shareholders of that company, to the existing shareholders of that wood, of that company. Yes, so those are basically two ways through which now this free transfer of shares is actually what? Is actually restricted. Maybe we can also say that or the other feature of this company here, number 4, we can say limit the number of members to 50, limit number of members to what? To 50. So the number of members in this company cannot exceed what? 50. Cannot exceed what? 50. So those are basically some of the features of this private company. So then we can proceed and look on the other type of company. Remember, this was under number 4. So number 5, we have public company. Public company. What is a public company? Public company is also defined under the Companies Act. And the Companies Act defines this, or we can say that a public company, this is a company which by its articles of association, number one, do not restrict members' rights to transfer shares. Members' rights to do what? To transfer shares. So in a public company, the right of members to transfer shares is not what? Is not restricted. And number 2 here, we can say that this one is not prohibited. From inviting members of public to buy its shares. Not prohibited from inviting the members of the public to do what? To buy its shares. So this company can invite the members of the public to buy, or in other terms, to subscribe its shares or debentures. And we will be able to see that whenever a company is inviting the members of the public to buy, to subscribe its shares, that company does that by issuing something called a prospectus. By issuing a prospectus. A prospectus is any invitation by the company to the members of the public to buy or to subscribe its shares or what? Or debentures. Number 3 here, we can say its certificate of incorporation. Each certificate of incorporation clearly states that it is a public company. States that it's a public what? Company. So this is the definition of a public company under the Companies Act. Under the Companies what? Under the Companies Act. Specifically, if you go to, and this is a document, in fact, you should be able to download. If you go to any browser, you type Companies Act of 2015 PDF document, you should be able to get this act. Yes, so it's good you have this particular act, because I've said most of things we are running here, they come from this act. Specifically, for example, in this case, if you download this act and you go to section 10, of this act, this is where you get this definition. That's why you get this word definition. Yes, that's where you get that definition of a public company. Now, in this case, it is also important. There is something I've mentioned here in relation to the features of the private company here, where we have said a private company can commence business upon incorporation. Once a company is incorporated or registered with the registrar, it will be issued with a certificate of incorporation. We have said that this company can be able to commence business upon receiving that certificate. But this one, that is a public company, it can only be able to commence business after receiving another certificate called a trading certificate. Trading certificate is not a business permit, because some students tend to confuse this with a business permit. A business permit is you get that from the county government. So, but a trading license, this is still a license which is issued by the registrar of companies. But a company is only issued with that certificate, and that only applies to public company once the company has been able to raise something called minimum subscription. Minimum subscription is basically the minimum amount of capital which is required by the company for its operation. Once this company has been registered with the registrar of companies, it is required to issue a prospectus inviting the members of the public to start buying its shares so that it can raise the necessary capital. So automatically the directors will have said that, or basically will have agreed on the minimum capital required by that company. So once that capital has been raised, the minimum capital required has been raised through the issue of shares to the members of the public, that is the only time the company can be able to start operation. And once the company raises that amount of money, it is required to notify the registrar of companies that they have been able to raise the minimum capital required. Once the registrar is notified, then the registrar will proceed and issue that company with another certificate called a trading certificate. Upon the receipt of that certificate, that is the only time a public company can be able to start operation, operation. And therefore, that capital, minimum capital required, which you're referring to as the minimum subscription, is the amount of capital required by the company to pay the preliminary expenses. Preliminary expenses are the expenses which are incurred during the formation of the company. If today you are forming a company, kuna zile expenses incur. So maybe you need to pay, there is something called a stamp duty payable to the government. You also maybe the registration of or the formation of the company maybe is done by your lawyer. So he will be charging you some small fee. So all those costs you incur in registering a company, refer to them as preliminary expenses. So minimum subscription must be enough to pay preliminary expenses, must be enough to pay for any asset or property acquired by what? By the company, must also be enough to provide the company with sufficient working capital. So working capital is basically money required for operation, but maybe buying inventory, paying the day-to-day operating expenses of the business, and so on. So therefore, once this company has been able to raise that amount of money, it is supposed to notify the registrar about the same, and basically the registrar will issue that company with a trading certificate. That is the only time this company can be able to start or operating. Yes. So are we together up to that point? If you're together, want us we move to the next thing. Are we together up to that point? Catherine, Stephen, Zido, are we together up to that point? Are we together up to that point? Okay, so I want us next we look on what? We look on the features, not the features, rather. I want us to look on the differences between these two types of companies, differences between the private and the public, private and public companies. So what are the differences? Which differences exist between these two companies? Which differences exist between these two companies? Remember, I've said these are the common types of companies which are formed by individuals to do business, either private or public companies. So which differences exist between these two companies? I think we have mentioned, we have come across some differences, like this one require a minimum of 1 member. For it to be formed, it requires a minimum of 1, whereas these require a minimum of 7 members, a minimum of 7. So this requires a minimum of 1 director, whereas this one requires a minimum of 2 directors. 2 directors. The other difference is that this company, that is private company, is not required to hold an AGM. As per the Companies Act of 2015, a private company do not have any mandate, do not have any responsibility of convening. It may hold an AGM, but it's not a requirement under the Companies Act. But this company here must convene an AGM. And actually, we will discuss more on these meetings, AGM, in the topic of companies meeting. We will see what is an AGM, when is AGM supposed to be held, and basically which business are transacted during such meeting. So the other difference is that this company here, we have said, can commence business after receiving certificate of incorporation. This company, for it to commence business, we have said, other than receiving this certificate of incorporation, it must additionally receive a trading certificate. The other difference is that private company here, basically have said restrict the right of members to transfer shares. Restrict the right to transfer shares. But this one does not do what? Does not restrict. This one does not restrict the right of members to do what? To transfer shares. Does not restrict the right of members to transfer what? To transfer shares. On the other hand, this one cannot invite the members of the public. To buy shares, whereas this one can do what? Can invite. can invite the members of the public to buy its shares. Can invite the members of the public to buy its what? Its shares. Can invite the members of the public to do what? To invite or basically to subscribe or to buy its what? Its shares. Maybe the other difference, we can say private company. Here, the directors are not required to obtain the qualification shares. Are not required to obtain the qualification what? Shares. So the qualification shares generally, these are the shares which the directors of the public company are required to obtain and pay within a period of 2 months from the date they were appointed. So that applies to directors of which company? Public company. So here the directors are not required to obtain the qualification shares, but here the directors are required to do what? To obtain the qualification what? The qualification shares. So those are some of the differences which exist between the private company and also the private company and the private and the public company, private and public company. So next, I think we can look on like the advantages of a private company over public company. So what are some of the advantages of a private company over public? So we have a number of advantages. One, we can say that this company here, private company, can be able to commence business upon incorporation. So once this company is registered with the Register of Companies, it can be able to commence business. It can start operating. This company is not required to obtain trading certificate. That is one of the advantages. Number two, because for this company to start operation, other than being issued with a certificate of incorporation, it must then wait and acquire the other trading certificate. Now, the other advantage of this company is that for it to be formed, it requires a minimum of one. It requires a minimum of one, meaning that to form a private company is much simpler because just one person is what is required. So the other advantage of this company, that is a private company, this company is not subjected to publicity requirement. Is not subjected to publicity requirement. What does that mean? It basically means that this company here is not required to, for example, one, publish its financial statements, make its financial statements available to the members of the public, which applies to public company. Public company must publish its financial statement, must make its financial statements available to the members of the public. Equally, in a public company, most of its documents, including MOA, AOA, and public documents, they are documents which can be accessed by any member of the public, which does not apply when it comes to what? When it comes to private companies. So the other advantage of this company is that private company is not required to hold an AGM. Remember, this is an advantage because if a company has to convene an AGM, we know that there are some costs which will be incurred, some logistical costs which will be incurred. The company must get a venue. Maybe the company will need to bring an MC. The company need to have other logistics put in place. All that means that the company will have to incur some expenses. On the other hand, if, for example, this company, the public company, fails to convene this meeting as required under the Companies Act, it can be fined. It can be required to pay a fine to the registrar because it is not complying with the requirements of the requirements of what? The requirements of the Companies Act. So those are basically some of the advantages of a private company. But on the other hand, we have various advantages of a public company over private. So what are some of the advantages of public company over private? One is access to capital. So if these two companies want to raise capital, the company which can be able to raise capital very fast and easily is the public company, because this company can issue shares to the members of the public, unlike private company, which is restricted from issuing its shares to the members of the public. So we can talk of easy access to capital. Number two, is something called 𝐎𝐍𝐋𝐒 strategy. So if you have invested in a private company, it is basically easy to exit because you can just be able to sell your shares anytime and to any other person, unlike in a private company whereby your exit may be declined. Maybe you want to sell your shares, but the director tells you no, you can't sell your shares. In a public company, there is an easy exit strategy. So the other one is basically about spreading of risk. So in a public company, shares are issued to so many shareholders. So the risk has been spread to so many shareholders, unlike in a private company whereby shares are issued to maybe few individuals, to few individuals. And the other one is about the ease of selling the shares. Ease of selling the shares. If you want to sell your shares, you can be able to do that with ease. And there is no much restrictions in relation to that. In relation to that, yes. So that basically some of the advantages of the public company over private. Now I want us to take a short break. I think we can just take a short break of 10 minutes, and then we come back. We look on the remaining types of companies, the other types of companies, and maybe we will wind up by looking on. We see whether we will be able to wind up on this. But basically, I want us first of all we take a short break, then we come back after that short break of 10 minutes. We come back at exactly 1:18. We continue. Yes, so let's continue. I hope you're back. Yes. Are you back? Catherine, Stephen, Zido, are you back? So that we continue. Are you back? Okay, so I want us to continue with the discussion here. And I think we have just discussed on some of the advantages of a private company over public, and also the advantages of a public company over a private. So next, I want us to look on the other type of company, number 6, and that is the unlimited company. So unlimited company is what? So unlimited company basically is that particular company where the liability of members is unlimited. What does that mean? The liability of members is unlimited. It basically means that if, for example, this company that is not able to pay its debt, then what will happen is that the members of such a company will be required to come in and contribute money to pay those particular debts of the company. So meaning that this company here is just the same with a partnership, is the same with a sole proprietorship business. So the only difference is that this company one will be having perpetual succession, and also the company will be having the separate legal personality, but the liability of members is unlimited. Number 7, we have company limited by guarantee. Company limited by guarantee. And the company limited by guarantee, number 1, these are those companies which do not have share capital, Actually, this company have like 3 features. These companies, number 1, do not have share capital. What does that mean? It basically means that this company do not raise capital by issuing shares. Simply because mostly company limited by guarantee are the not-for-profit making organizations, like the NGOs which are formed, they fall under this category here. And basically what we know is that NGOs rely on donations. They are funded by donations, and also maybe grants from the government. Maybe, for example, the government a grant. They do not have share capital. They do not raise capital by issuing shares. Number two, these particular companies here are not formed to make profit. Not formed to do what? To make profit. They are not formed to make what? A profit. And that's why I've said NGOs, they fall under this what? Category. And number 3, these companies for the liability of members. The liability of members is limited by what? Is limited by guarantee. Is limited by what? By guarantee. So by saying that the liability of members is limited by guarantee, it basically means that when these companies are basically to be formed, each member of this company basically make a commitment that in case the company is not able to pay its debt, then they will come in and contribute a certain amount of money to help the company in terms of paying its debts. So if you are a member here, so during its formation, you must commit yourself to contribute a certain amount of money to help the company in terms of paying its what? Its debts. That's what you mean by the liability of members being limited by what? By guarantee. So these are basically the feature, the three features of these particular companies here, which are company limited by what? By guarantee. So then we can proceed and look on the other type of, or the other classification of a company. That was number 7. Number 7. So we have number 8. Number 8, and that is the company limited by shares. Company limited by shares. So when we talk about the company limited by shares, these are those particular companies where the liability of members is limited by shares. The liability of members, liability of members is limited by shares. Is limited by what? Is limited by shares. So what this means is that in case this particular company is not in a position to pay debts, then as a member of this company, you will only be required, or basically as a member of this company, the obligation which you have as far as the payment of those debts of the company is concerned is paying the amount of money which you have not paid on the shares you have been issued with. For example, you have been issued with 10,000 shares. Maybe there is some amount of money you have not paid for those shares. So what you'll be required to do in that in this case is you pay that amount which you have not paid on your shares to help the company to raise money to pay its debts. That's basically what you mean by your liability being limited by shares. Your obligation as far as the payment of the company's debt is concerned is limited to paying any amount of money unpaid on your shares. If your shares are fully paid, then can you be required to come in and pay any amount of money here? Automatically, no, because your shares are fully paid. So that's what we mean by company limited by what? By shares. So then from there we have a holding company, holding and a subsidiary company. Holding and subsidiary company. I think in this case, we can start by defining what is a holding company. So holding company, essentially, this is a company which has acquired the majority of the shares in another company. For example, you're told 𝐻 Limited has acquired more than 50%. That is majority of the shares in B Limited. This company here is the one which is called the holding company. The holding company. In other terms, this one is also called the parent company, the holding or the parent company. For us now, this company here is called the subsidiary company. It's called the subsidiary company. So, but by definition, how do we define a holding company? So a holding company, this one is defined under the Companies Act, specifically Section 3 of the Companies Act of 2015. And actually, a holding company, we say, this is a company. Basically, we have 4 definitions. Is a company that number one controls the composition of the board of directors. Control the composition of the board of directors of another company. Controls the composition of the board of directors of another company. So a company is said to control the composition of the board of directors of another company if that company is the one which appoints majority of the directors. For example, A Limited, taking into account its whole majority of the shares in B, A Limited will be the one which appoints majority of the directors of B Limited. It therefore controls the composition of the board of directors of B Limited. Number 2, we say is a company that do what? That controls more than half. Controls more than half of the voting rights of another company. Voting right of another company controls more than half of the voting rights of another company. If A Limited hold majority of the shares in B, it basically means that A controls more than half of the voting rights in B what? In B Limited. And number three, holds more than half of the issued of the other, that is of the other company share capital. Other company share capital. So this company holds more than half of B Limited share capital. So therefore, this is the parent, whereas B is what? Is a subsidiary. And then number four here. Number four, we can say it is the holding company of a company. It is a holding company of a company that is of a company, okay, of a company which is another company holding company. So what have we said here? We have said that a holding company is a company that is a holding company of a company which is another company holding company. What does that mean? So let me illustrate that so that you understand. Assuming you have three companies, A Limited, which basically has acquired more than 50% of the shares issued by B Limited, and then this one hold more than 50% of the shares issued by who? By C. So in this case, you can see A controls B simply because this one has or basically acquires or hold more than 50% of the shares issued by B, and then B in turn controls what? Controls C. So this company controls this, and this in turn control C. So therefore, in this case, we can see A has got some indirect interest, not indirect interest, indirect control over C. A Limited has indirect control over C. So therefore, A Limited will be a holding company as far as company C is what is concerned. So this definition number 3, definition number 4 of a holding company basically it applies to this. It applies to this, where we are saying A is a holding company of company C, simply because we are saying A is a holding company of a company, is a holding company of this company, is a holding company of a company which is another's what? Holding company. So this is a holding company of this, which in turn is a holding company of another company. So therefore, A Limited is a holding company of company what? Of company C. So that is the definition of what we refer to as a holding company. So if you come across a question required to define a holding company, you need to remember those 4 definitions. Those 4 what? Definitions. Okay. So next, number 10, I want us to look on something called the foreign companies. Foreign companies, in other terms, these are known as companies incorporated outside Kenya. Incorporated outside what? Kenya. So we'll talk about the companies incorporated outside Kenya. These are those particular companies which are registered or basically incorporated in any other country other than Kenya. And this company have started operating in what? In Kenya, have started operating in Kenya. For example, a company registered in Uganda, but that company has started operating in Kenya. Now, that company, we refer to it as a foreign company. Now, the requirement of the Companies Act is that for that company to start operating in Kenya legally, it has to be registered with the Registrar of Companies as a foreign company. So that company will be required to make an application with the Registrar of Companies for it to be registered in Kenya as a foreign company. Once the registrar receives that application, he will go ahead and basically register that company, provided that application for registration meets all the requirements of the Companies Act. And that company, once registered with the Registrar of Companies, it will be issued with a certificate of registration, meaning that it has been registered in Kenya or it has been registered by the Registrar of Companies as a foreign what? As a foreign company. As a foreign what? As a foreign company. As a foreign what? A company. Yes. So that's basically the other type of company. And then we also have something called the corporation aggregate. I'll define this together with something called the corporation sole. So these are basically not per se types of companies, but these are types of legal entities, or legal persons. So when talk about the corporation aggregate, this refers to those associations, which comprises of two or more persons. And mostly now the private companies, that is the public companies, or those companies which comprises of two or more persons, they are good examples of corporation aggregate. Associations which are comprises of two or more persons, which have been registered and also recognized as legal entities, separate and also distinct from their members. Corporation sole, basically these are the legal offices which are actually deemed to have the same status with companies. They are those one-man offices, which are basically established by the various provisions of the law. For example, the office of the president, the office of the attorney general, the office of maybe deputy president. Those are one-man offices which are established under the various provisions of the law and actually recognized to be legal entities, which are basically separate and distinct from their members. Members. So those are basically the various types of companies, which basically you need to be aware of. I think maybe some of the questions which I've seen here, maybe like I think last week. Yes, and therefore in today's class, I want us to start on this topic number 1, and the topic is nature and the classification of companies. So as far as this topic is concerned, we said that we are going to discuss a number of issues as far as the company is concerned. 1, we will start by defining what is a company, and then from there we look on basically the various characteristics or features of the company, and then from there we look on basically the classification of companies. How do we classify companies? Because generally we do have different types of companies. We are going to look on those different types of companies. But in this case, I want us to start by defining what is a company. And basically, in this case, when we talk about a company here, this one can be defined to be an association, of persons, which is basically formed for some lawful common purpose and also registered in accordance with the Companies Act of 2015. So therefore, this is what is association of what? Of persons. Association of what? Of persons, which is basically formed for lawful common purpose, and also registered in accordance with the Companies Act of 2015. So that is the definition of a company. So what do you mean by association of persons? Association of persons, basically, this whereby, for example, we may agree to come together and basically we start doing business together. Together. So therefore, association of persons, this basically whereby we have a number of individuals, 2 or more persons will come together. They agree to register a company in order to undertake some business, which by the end of the day is legal, or basically a business with a lawful. So that is basically the definition of a company. And basically in this case, we are saying that this particular association of persons, by the end of the day, it has to be registered in accordance with the Companies Act of 2015. Because if, for example, today we have agreed maybe to...
That class is to ensure we are recording. So now we have missed something. But no problem. So we are saying, so maybe just a recap. So we have said time value of money. It is that the fact that over time, the value of money changes. The value of money does not remain the same. And I'm saying, assuming here, now, that is year 0 today, and we have 10 years to come. 10 years to come. So we have 1 million shillings today here. Shillings 1 million. And here we have shillings 1 million. So we're saying the value of 1 million shillings today. This, it's like, if you remember what I said, assuming someone tells you that I give you 1 million shillings today, or you wait I give you 2 million shillings after 10 years. I either give you 1 million shillings today, or you can wait. I give you 2 million shillings after 10 years. Which one is better? And we said holding other factors constant, because there are other factors that can influence your decision. Maybe you are going through a difficult time and you don't care what you're going to get after 10 years, but holding other factors constant, just look at the 1 million now and the 2 million after 10 years. You said you would rather go for the 1 million, because this it may be if you determine what is the present value of 2 million shillings expected in future, because remember, this 1 million is in present value terms. This one is in present value. Present value means now. But this 2 million is in future value. This one is in future value. If an amount was be received in future, we say it is in future value form. If it's been received or paid today, we say it's in present value terms. So before you make your decision on whether to go for the 1 million or the 2 million, you're supposed to ascertain what is this 2 million in present value terms, because I'm being promised the 2 million in future value terms. But what is the present value of this 2 million in present value terms? That is, you bring it to present value terms. See, tumeanza kurecord. Oh, okay, yeah. So that was earlier. So what is this in present value terms? So when you ascertain the present value of these 2 million, that is bringing it in present value form, you may realize that it is 0.8 million. So if it is 0.8 million, you will say, I would rather go for the 1 million shillings today. Yeah, are we together? You would rather go for the 1 million shillings today, but you cannot compare 1 million and 2 million. Those two figures are not comparable, because one is in present value terms, the other one is in future value terms. You cannot compare an amount in present value terms with an amount in future value terms. If you want to have a fair comparison, or if you want to form an even ground for comparison, you must either take this 1 million to future value or bring this 2 million to present value. And the most important thing, it is bringing, okay, either way can work. So, but you must compare the two amounts in same form, either in present value terms or in future value terms. And that is where now the concept of time value of money comes in, determining either the future value of an amount or the present value of an amount. Now, let's say something now about the time value of money. So time value of money, we've said here we have present value, and future value. So present value, we have that direction, and we have this direction. So this is to say, you can work from present value terms to future value, or you can work from future value to present value. When present value to future value, when we are doing present value to future value, we call it compounding. This one you must have done in mathematics, compounding. Compounding, it is determination of a future value from a present value. Determination of a future value from a present value. For example, in our example here, you have been given 1 million. You want to know, if I get this 1 million today, I'm going to invest. Remember, you're not just getting the 1 million and keeping it maybe under the bed. No, you'll get the 1 million and invest somewhere. If you invest, it will earn a return. So after 10 years, you will not just have 1 million, but you'll have 1 million plus a return. So we want to know this 1 million plus the return that you're going to earn, how much will it be after 10 years? That is determining the future value from a present value. And that is what we call in compounding. That is compounding. The other one, we are moving from future value to present. Like in this case, you're being given 2 million shillings after 10 years. But we want to know what is the worth? What is the worth of 2 million shillings 10 years to come? What is the present value of this amount? So you go backwards. Working from future value to present value, we call it discounting. Discounting. This is discounting. Discounting its determination of a present value from a future value. Determination of a present value from a future value. And I've said, when you are given an amount in present value terms and another amount in future value terms, and you're supposed to compare the two, you cannot compare when they are not in the same form. You're supposed either to convert them to present value or to future value and make a decision or make a conclusion. That is all about time value of money. So let's see what we have in the handout. There is a handout I've just shared. There is a handout I've just shared in the WhatsApp group. Kindly check. Kindly check. Have you seen that handout? I shared just a few minutes before the class. I want us to look at it. In case you have a question, you can ask before we proceed. In case you have a question, kindly ask. Okay, fine. Let's. I want to believe you've seen the handout. It's important to respond. Kindly respond if you've seen the handout. Okay, fine. Let's continue. Thank you, Alice and Akin, Alan as well. So up there, you can see the introduction, concepts of time value of money, introduction. A shilling today is worth more than a shilling tomorrow. All what I've explained is what you can find there. Future value techniques. Future value techniques, you can see there we have future value. That is what I've explained. An amount that will be paid or received in future, we call it a future value. Then we have present value techniques. Present value, I've said, is an amount today. As an amount today, present value. Compounding techniques, but I'm not saying you are going to make sure you go through this, the theory part, at your own free time. But this is what I've just summarized. There is no need of repeating. I just want us to walk through. Compounding techniques. Compounding techniques, we've said, okay, this is what we did in mathematics. Simple interest and compound interest. So again, that is not important, so much important. I just want us to look at the, but let's, yeah, we are under compounding techniques. Here we've talked about two concepts, the concept of compounding, the concept of discounting. So I want us to start with compounding. That is compounding techniques. That's the reason why there they are saying compounding techniques. Compounding techniques. So we start with the compounding techniques, number one. Determination of a future value from a present value. Compounding techniques. Compounding techniques. Now, we start with future value of a lump sum. Okay, in here, we will not focus too much on the illustrations that we have there in the handout. I want you to make short notes. I want you to make short notes as we continue. I have some handwritten notes here. that I want to share with you. So just write concepts of compounding, or compounding techniques, and we start with the first one: future value of a lump sum. 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 Alan? Okay, I will share. But the handout is more summarized. So we start with future value of a lump sum. Now, when you talk about, the most important thing here to understand is what is a lump sum? What is a lump sum? A lump sum, this is an amount that is received or paid once. An amount that is received or paid once is what we call a lump sum. For example, let's say if you pay or receive 2 million shillings today, that is a lump sum. Or if you invest, let me show you. Let's first understand. We have two things here. We have a lump sum. We have a lump sum. And we have an annuity. And an annuity. So here, let's say we have periods. We have period 1, 2, 3, 4. So we have amounts. Let's start with lump sums. Lump sum amounts. Lump sum. Let's say in year 1, the amount is 300,000. In year 2, it's 550,000, 600,000, and 700,000. These are what we call, all these are lump sums. Okay, let's have annuities. Annuity amounts. These are like installments. They are equal 400,000, 400,000, 400,000, 400,000. So annuities, they are equal amounts received or paid regularly. Equal amounts received or paid regularly. And we say, when we say regularly, we are saying it's either monthly, weekly, semi-annually, yearly, quarterly. That means like every month you're paying or receiving 400,000. That is an annuity. Or each year you're paying or receiving 400,000. That is an annuity. Equal amounts received or paid regularly. Lump sum amounts. Lump sum amounts, you're saying this is an amount which is received or paid once. They do not repeat themselves. For example, in year 1, you'll receive 300,000. In year 2, you're getting 550 or paying or 550. Year 3, 600. Year 4, 700. Maybe let's say year 5, 300,000. You cannot say that since 300,000 is appearing twice, that it is an annuity. No, it is not an annuity because it has not been received regularly. You've received 300,000 after some other cash flows have been received here. Are we together? So all these are lump sums. All these are lump sums. However, if, for example, if you get 300,000 here and 300,000 here, we have two 300,000 that follow each other, this one and this one. This one will be referred to as an annuity. This is an annuity. Year 1 and year 2, or period 1 and period 2, we have an annuity of 300,000 because they follow each other. Yeah? But if the 300,000 occurs after, let's say, for example, here we have 700,000 and here we have 300,000. So in Year 1 and year 3, we have 300,000. These are not annuities, they are lump sums, because in between them, there is a figure that is different from them. I want to believe that is very clear. That is clear. A lump sum and an annuity. This is a concept that we are going to use a lot in financial management. And that is why I want you to be able to differentiate lump sums and annuities. Again, so this was 6. Let's say this was what? This was 500. Let's say now, yeah, 300,000 there. 300, yeah, let's say 300,000 here. So in year 4 and year 5, the 300,000 becomes an annuity because they follow each other. We have two 300,000s that follow one another. So they are annuities. So I want to believe that is clear. That's okay? Okay, fine, let's proceed. So we now looking at future value of a lump sum, future value of this kind of cash flows, future value of this kind of cash flows. So when you want to determine the future value of a lump sum, future value of a lump sum, future FV, its future value of a lump sum is equals to present value, or let's say principal, what you are used to, principal times 1 plus r power n. Principal times 1 plus r power n. And this is what you call present value. Present value. This principal figure here is what we call present value. Let's see. Let's see what we have in the handout there. Check what we have there. Where are we? Where are we? Future value of future value of a lump sum should be there. If you look at the handout, you'll see using tables to find future. No. Equation for finding future values of a single amount is derived as follows. How it is derived is not so much important to us. The most important thing is this. Yeah, this is how we get the future value of a lump sum. Future value of a lump sum is equals to principal into brackets present value times 1 plus r power n. This factor here, this factor 1 plus r power n is called what? Future value is called future value interest factor. This one is called future value interest factor. Future value interest factor. That factor is called future value interest factor. This one is very important. 1 plus r into bracket power n. So here we can say where FV is future value, R is the discounting, or not discounting rate, but rate of return. It's important for you to write this formula. Just write this, just write that. Rate of return is like the interest rate. Rate of return is like the interest rate. Yeah. Do you have an example there? So the example, yeah, there should be an example somewhere. Yeah, there is an example there. Look at that example. They're saying, assume that you've just invested Kenya shillings 100,000. The investment is expected to earn interest at a rate of 20% compounded annually. Determine the future value of the investment after 3 years. So, okay. Let's look at that. We are doing that illustration, that example. We're saying, assume that you have invested shillings 100,000. That is the present value. That is the principal. The principal amount, which is present value amount, is Kenya shillings 100,000. 100,000. Then the investment is expected to earn interest at the rate of R is 20% per annum. This per annum is very important. Okay, it is not given. They have not said per annum, but we say when you get a rate of return where the period, whether the per annum, per month, semi-annually is not stated, the standard measure is per annum. So unless it is specified like semi-annually or what, you should take it as per annum rate. So per annum is 20%, compounded annually. Determine the future value of the investment after 3 years. N, we should have said N here. N is equals to number of periods. Number of periods. Kindly have that. Number of periods. Number of periods. Make sure you write that. So here, our period is 3 years. We are investing for 3 years. So future value, we are saying, is equals to present value 1 plus R power N. So future value is equals to 100,000 times 1 plus 0.2 power 3. Power 3. So get the value of the investment after 3 years. Value of the investment after 3 years is how much are you getting? There are people, no, but you must be knowing how to put this power 3 in calculators. Anyone who doesn't know, you will be assisted. Now, for example, we have two answers here. We have 172,800 and we have 106,120. Alice, I'm doubting your answer. At a rate of 20%, even in the first year, we are going to earn 20,000. Because first year one, we will say 20% times this. Times 100,000, that is 20. That means it's more than 106,000. So 178, probably 172,800. 172,800. At least repeat your calculation. Okay, yeah, 172,800. That is what you're supposed to do. Another method of getting this. Another method of getting this is or. So here you say or a very long method. You'll say period here. Period 1, 2, and 3. Amount. Let's say 100,000. No, will that give us? No. No, that is the only way. Okay. The other method is where we say, but this one is very long. Where you say here it's 1 plus 0.2. The figure that you'll get here, you bring it here. Then you continue. But that will not apply in this case because we are only investing 1. So you can continue. You grow by that rate. So just stick to this. Just stick to this. Any question before you continue? We want to proceed. Okay, number 2, future value of an annuity. Future value of an annuity. Future value of an annuity. Future value of an annuity, and you have seen how we get the future. I've explained what's an annuity. Future value of annuity. Future value of annuity. Now, a future value of an annuity, just like we've said, you get the annuity. It's an annuity when the amount occurs repetitively, but regularly. So future value of an annuity is computed as follows. Without wasting a lot of time, future value of annuity is equals to the annuity. You get the annuity amount times annuity amount times. So we have the future value annuity factor. The future value annuity factor, you say 1 plus R power n minus 1 over R. That's how we get the future value of an annuity. 1 plus R, and write these formulas because the way they are in the handout. Okay, they are very much simplified in the handout. Just write what I'm writing on the board. Yeah, it's there, but write. Future value of an annuity is equals to annuity times 1 plus R into brackets power n minus 1 over R. This factor here, the factor 1 plus R power n minus 1 over R is called future value interest factor of an annuity. Future value interest factor of an annuity. What have they said there? Future value interest factor of an annuity. Future value interest factor of an annuity. This one. Now, we have tables. We have tables where these factors can be read from. Like you remember what table do we have? We have math table. Do you people know what's a math table? Or maybe what we call what? Normal curve, normal distribution curve. We have tables. We have tables where you can read these factors. When we go to discounting, I'm going to share the tables so that we can see. But for future values, the tables for compounding, it's not widely used in financial management. So just get these formulas right. Yeah. So any question here? There is nothing to explain. We know R is the rate of return or the interest rate. N, it's the number of periods. So there is nothing to explain. Let's go to what? Let's have an illustration. Do we have an illustration there? From the above example, there is a statement that says no. We have an example. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest of 12%? Are you there? Have you seen that example? And finding future value of an annuity. Oh, that's due. Sorry. What is the value of 100,000 investment annually at the beginning? That's an annuity due. We are coming to that. I want us to have an illustration on an illustration on future value of an annuity. Okay, let's say from the above example, there is a part that is missing here. There is a part that is missing, but all in all, let's just write an example there. Just write something. Just write an example, an illustration. Say an investor intends to invest. An investor intends to invest shilling 60,000 at the end of each year for 4 years. An investor intends to invest shilling 60,000 at the end of each year for 4 years. At the end of each year for 4 years. Full stop and say, the investment will earn interest. The investment will earn interest at a rate of 20%. The investment will earn interest at a rate of 20%, compounded annually. The investment will earn interest at a rate of 20%, compounded annually. Compounded annually. Full stop. Determine the future value. Determine the future value of the investment. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. After 4 years. Now, future value of the investment. Now we start. This is how you should be approaching these questions. You first analyze the question. For example, here we are saying amount to invest is 60,000 at the end of each year. So annuity. We say annuity. Shillings 60,000. Annuity shilling 60,000 at the end of each year for 4 years. Period is 4 years. 4 years. Then the investment will earn interest at a rate of 20%. So 20% per annum. So we want the value of the investment after 4 years. So future value of annuity is equals to the annuity times 1 plus r power n minus 1 over r. So here you say 60,000 times 1 plus 0.2 power 4 power 4 minus 1 over 0.2. So get the value of the investment after 4 years. Then I show you another way of doing it. Get the answer, get the answer. Get the answer. $322,080. $322,080. Another person. $322,080. Another person. Alice, okay, that's fine. Now, there is another way of doing this question. So this is now, you say period. period 1, 2, 3, 4. Annuity or amount. Remember, this person is investing 60,000 at the end. Yeah, at the end of each period. 60. 60. 60. 60. At the end of each period, this person is investing 60. So here you say 1 plus R power n. If we want to treat each amount as a lump sum, then here we will have future value. Future value. So here we will have 1 plus R. 1 plus R. This is 0.2. 0.2. 1 plus 0.2. 1 plus 0.2. 1 plus 0.2. 0.2. 1 plus 0.2. So before that, we know we've not put n. That is what I want to illustrate here. That is what I want to illustrate here. So we are 0. We always start at 0. 0 means now 1, 2, 3, 4. We're talking about 4 years, which is 1, 2, 3, 4. So here we have at the end. We are investing at the end. So at the end of the first year, 0, 60, 60, 60, 60. I want us to put n. So this 60 that you've invested at the end of year 1, how many times will it earn interest? The 60 that you invested at the end of year 1, how many times will it have earned interest at the end of year 4? It is here. 1, 2, 3. We have invested 60 here, so it will earn a return here, a return here, and a return here. So you say power 3. That is power 3. Then the other 60 at the end of year 2 here, it will earn interest here and here. So you say power 2. The 60 that you invest at the end of year 3, it will earn interest once. So you say power 1. And the last one, the 60 that you are investing at the end of year 4, it will have earned no return. So you say power 0. So multiply and get the total. If you multiply and get the total, we should be getting the same answer as this. We should be getting the same answer as this. So the reason why I just want you to get the concept here of power what, power what, power what. So 103,680 must be the first one. 103,680. 103,680. 86,400. 72,000 and 60,000. So get the total. Get the total. $322,088. Yeah. So almost the same as what we have here, just because of rounding off, that's where there are differences. So is that okay? Let's proceed. Let's do the next one, then we go for a break. The other one is future value of an annuity due. Future value of an annuity due. Let's wrap this. Future value of an annuity due. Now, what we have talked about here, it is an annuity that occurs at the end of the period. So here we had 60. If an annuity occurs at the end of the period, like in this case, that is what we've done in part B. But now we have what we call okay, fine, Alice, 080. Okay, fine. So future value of an annuity, this is when the amount is invested or paid at the beginning of the year. At the beginning of the year. For example, if our 60 here, 0, 1, 2, 3, 4. If the investment is done at the beginning of the year, for example, here 60, 60, 60, 60, 60, we call it 1, 2, 3, 4. This is not there. We call it an annuity due. So an annuity due is an amount that is invested or paid at the beginning of the period. And this will change because now, like here we had said this is power 3 because we counted here 1, 2, and 3. But if it's an annuity due, we will now have 1, 2, 3, 4 because we are going up to the end of year 4. Because we are going up to the end of year 4. So the amount that we invested at the beginning of year 1 here will earn interest 4 times. 1, 2, 3, 4. The amount that we invested at the end of year 1 will earn interest 1, 2, 3. This will earn 1, 2, and this will earn 1. So the entire thing will change there. But now, how about when we are using the formula? When we are using the formula, this is how we get the future value of an annuity due. So here we say future value of annuity due is equals to annuity times 1 plus r power n minus 1 over r. Then we add another factor here, 1 plus r. 1 plus r. 1 plus r. One plus r power n minus 1 over r times 1 plus r. So this is now what caters for the element of investing at the beginning of the period. So you can write that. And then we have an illustration. So back to the handout, there is an illustration. Finding value of an annuity due. We have an illustration for that. If you can check in the handout, they're saying, assuming the above example, the investment is made at the beginning of the year rather than at the end. So example, what is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest rate of 12%? So let's do that. So we're saying, what is the value of shillings 100,000? So annuity, the annuity is 100,000. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years? The period is 5 years. Interest is 12% per annum, and it's at the beginning. So future value of annuity due is equals to the annuity. And you need to be writing these formulas every now and then. Every time you're doing a question, kindly write the formula. Even if you know the formula, just write it. So annuity times 1 plus R power n minus 1 over R times 1 plus R. So annuity is 100,000 times 1 plus 0.12 power 5 minus 1 over 0.12, then times 1 plus 0.12. So get the value. Then you are going to use this method to see. So how much are you getting? 711,518.9. 711,518.9. Now, using this method, we will have this. We will have here 0 here. 1, 2, 3, 4, 5. And remember, the reason why we are starting at 0, you must count 12. Oh, someone else is getting 424, eh? 711, 424. Okay. Another person? A third person? Okay, let's continue as we wait. So, 513, 518, around that range. Now, so I'm saying we start at 0 because we must count 518. Okay, fine. Let's go with 518. We must count 12 months before we call it a year. So we are saying we are investing 100,000 at the beginning of each year. 100,000, 100,000, 100,000, 100,000. Remember, the end of year 1 is the beginning of year 2. So this 100,000 here we are investing at the beginning of year 2, which is the end of year 1. So we are saying this first 100,000 that was invested at the beginning of year 1, how many times will it earn interest in a period of 5 years? 1, 2, 3, 4, 5. So you say power 5. The other one is power 4, power 3, power 2, and power 1. The last one that we are investing at the beginning of year 5, it will also earn interest during year 5. So at the end of year 5, it will have earned once. That is why we're saying power 1. If you do the future value here, you're supposed to get almost the same answer as what you're getting here. So just check whether you're getting the same. One 76 to 34 point you can, okay, in this case you can round off. In this case you can round off to whole numbers. You can round off to whole numbers. In this case, there are situations whereby the decimal points will be required. So let's round off to whole numbers. The first one then should be 176 to 34, 157, 352, 157, 352, 144, 93, 144, 93, 125 for 40, 125 for 40, and 112,000. So get the sum. $711, $519. $711,519. Now the reason why we are doing these two methods, this is very short. This is like a shortcut, but we are doing this method so that you can get the concept, because there are questions that will tell you that the amounts were invested at the beginning, the amounts were invested at the end of the period, this and this was happening. So this one is very important. Kindly get the concept. Then after the break, we will look at discounting techniques. Discounting techniques. After the break, discounting techniques. discounting techniques. So let's have a break of like 5 minutes. And as we've said, discounting is this determination of present value from a future amount. Determination of present value from a future amount is what we call discounting, or rather, yeah, discounting. So we start with the first one. Present value of a lump sum. Present value of a lump sum. Present value of a lump sum is the first one. A lump sum, still the same thing as we've said, an amount that is paid or received once is what we call a lump sum. So how do we get the present value of a lump sum? Present value just say PV, present value of a lump sum is equals to future value times 1 plus R power negative N. 1 plus R power negative N. So look at this factor now. Look at this factor now. Under compounding, we were saying power N, positive N, because we were moving forward. But now, under discounting, we are saying negative, because we are moving backwards. So get the difference. Present value for lump sum is equals to future value times 1 plus R power negative N. So where this is future value, R we said is the required rate of return. N is the number of periods, as usual, number of periods. Now this factor, the factor 1 plus R power negative N, the factor 1 plus R power negative N, we call it present value interest factor. This one, we call it present value interest factor. Present value interest factor. In this one, we can read from the tables. So present value interest factor, which is indicated as this present value interest factor, R% power N. Present value interest factor, R% power N. So let me share with you the present value interest factor tables. The present value interest factor tables. Just check on your WhatsApp. Check in the WhatsApp group, I mean. I'm sharing the present value interest factors table, present value interest factor tables that we use for discounting. Present value interest factor tables that we use for discounting. I have shared Once you receive it, kindly let me know. Once you receive it, kindly let me know. I want to show you how we read. Oh, okay, but that one you're going to do in an illustration. We're going to do in an illustration. So what do you need to add here? Nothing. Nothing. So when we are using tables, we say present value of a lump sum with tables. We say present value of a lump sum is equals to future value times present value interest factor R% power n. So this factor here, this is R, this is R, this is R% power n. Present value for lump sum is equals to future value times present value interest factor R% power. Because this factor should give us same figure as we have here. So let's have an example. I want to believe we have an example there. Let's go to discounting. Skip issues to do with quarterly discounting and semi-annually discounting. Let us go to discounting techniques. Discounting techniques, and we have an example there. We have an example there. Example says, assume you were to receive shillings 172,800 3 years from now on an investment, and the required rate of return is 20%. What amount would you receive today to be indifferent? So we are saying, assume you were to receive shillings 172,800 3 years from now on an investment, and the required rate of return is 20%. What amount would you receive today to be indifferent using, that is, using present value? Okay, ignore that. Just ignore that. So here we have been given the future value. We've been given the future value. So here we're saying future value, it is the amount that you will receive in future. 172,800. Assume you are to receive 172,800 3 years from now, and 3 years. And the rate of interest is 20%. 20% per annum. So here we will say present value is equals to future value 1 plus R power negative n. Power negative n. So present value is equals to 172,800 times 1 plus 0.2 power negative 3 power negative 3. In short, how much are you supposed to invest today to earn to get 172,800 after 3 years at an interest rate of 20% per annum? Again, you say 100,000. 100,000, okay. 100,000. And or present value is equals to future value times present value interest factor R% power n. So this one you write 172,800 times present value interest factor 20% power 5. 20% power 5. So 172,800. So this factor now, we are going to read it from the tables. We are going to read that factor from the table that I've just shared. From the table that I've just shared, let's go there. From the table. Are you there? Kindly confirm. Confirm we're together. Oh, it's power 3, sorry. Power 3, power 3. Power 3. Thank you for your correction. I want to believe you have the table that I've shared. Now, in that table, in that paper, there are two tables. We have upper one and the lower one. And you can see some formulas written above there. So you can see the first one, they have written present value interest factor, present value of received at the end of periods, end periods. And we have the other one down there, present value of an annuity of 1 per period for n periods. So the upper table is for lump sums. The upper table is for lump sums. The lower table is for annuities. The lower table is for annuities. Now we are talking about lump sums. We are looking at the present value for lump sum. So you will go to, if you look at the upper row, in table 1, the upper row, we have percentages. The upper row, the first row, if I can say, we have percentages. And in the first column, we have periods. We have periods. So like, for example, we have, so we have periods upper. We have 1, 2, 3, 4. Then we have these percentages, 1%, 2%, 3%, all the way to 20%. We want 20%. So now, in our case, we are interested in 20% at period 3. 20% at period 3. So you go to period 3 and move up to 20%. You read the factor that is there. Just like we were doing in multiplication tables. Just like we were doing in multiplication tables, that is what you are doing. You go to the period, then go to the percentage. Or you go to the percentage, you drop up to the period that is required in the question. So read the factor that is there. At 20%, period 3. 20% at period 3, you're getting. Write the factor there, 0.5787. 5787. 0.5787. 0.5787. Then you multiply now. 0.5787. 5787. So then you multiply by this factor, but not factor, but amount. How much are you getting? 99.99.36. That is just like 100,000. You can see these factors are rounded off to 4 decimal places. So, but that is what you're supposed to do. That is what we are supposed to do. Any question? Any question? Okay, fine. If no question, we proceed. Present value, present value of an annuity. Present value of an annuity. Present value of an annuity. We have seen what an annuity is. Present value of an annuity. Present value of an annuity. And the present value of an annuity, we say present value of annuity is equals to the annuity times 1 minus 1 plus r power negative n over r. So have that. Present value of an annuity is equals to the annuity times 1 minus 1 plus r power negative n over r. Then we are saying this factor, the factor 1 plus 1 minus 1 minus 1 plus r power negative n over r is called present value interest factor of an annuity r% power n. Present value interest factor of an annuity r% power n. Thus, present value of an annuity is equals to the annuity times present value interest factor annuity r% power n. R% power n. I can't find 0.5787. Catherine, let's go back to that table. Let's go back to that table. The upper table, 5787. We are using the upper table, Catherine. Are you there? Kindly confirm you're there, Catherine. Go to 20% under column, under row 1, the top row, go to 20%. After reaching 20%, go down to row 3. Not 3, but count 1, 2, 3. At 20%, you should go up to 0.5787. You'll see, yeah, that's how we read this thing. So for the annuities, this is how we, and you should be able to compute this. You should be able to use this. Remember, this formula here, this formula that you're seeing here, this one, it gives us the same figure as what we have in the tables, rounded off to 4 decimal places. You round this to 4 decimal places, you're supposed to be getting the same figure. So nothing different. So let's see an illustration. An illustration present value of an annuity. Yeah, we have an illustration and a present value of an annuity. An illustration and a present value of an annuity. And they're saying, assume that a project will give you shillings 1,000 at the end of each year for 4 years. What is the maximum amount would you be willing to pay for that project if the required rate of return is 10%? So let's do that. Now, when you are ever told to determine the maximum price to pay, and I saw that kind of a question in the last sitting paper, every time you are ever told to determine the maximum price to pay, the maximum price to pay for an asset or for anything must be equal to the present value of the expected benefits. Must be equal to the present value of the expected benefits. Maybe we can have a look at, do you have your past papers? Let's look at the past papers. Just open your past papers. I show you that question. Past papers. It must have been question 2 or 3. Open your past papers. The August 2025 paper. The August 2025 paper. August 2025 paper. Which question? Question 4A. Not sorry, not that one. Now, yeah, question 4B. Question 4B. Question 4B. If you're there, you will see that required is advise an investor interested in Mara Limited on the maximum price to pay per share. So maximum price to pay. We say maximum price to pay, maximum price to pay is equal to present value of all expected benefits or cash flows. Benefits or cash flows. So if it's a share, to get the maximum price to pay for a share, it is the present value of all expected dividends from that share. If it is an asset, like for example, you want to buy a motor vehicle for commercial purposes, the maximum price that you're supposed to pay for that motor vehicle, it is the present value of all what you're expecting to earn from it. So that is what this question says. So back to the question. So what I'm trying to say is that some of these things you don't need to forget. Like I'm sure this is something that I repeated a number of times last semester. And you see it came in the exam. So maximum price to pay, kindly note, because it's a concept that will keep on applying. Back to our illustration. So they're saying, assume that a project will give you shillings 1,000 at the end of each year for 4 years. Annuity. Annuity is shillings 1,000. Number of periods is 4 years. 4 years. And they're saying, what is the maximum amount would you be willing to pay for that project if the required rate of return is 10? R is 10. R is 10%. So maximum price to pay, this is present value of annuity. This is the present value of our annuity. So present value of an annuity, present value of annuity is equals to the annuity times 1 minus 1 plus R power N over R. So our annuity here is 1,000 times 1 minus 1 plus 1 minus 1 plus 0.1 power negative 4 over 0.1. So shillings. Get the figure. How much are you getting? That 169.87. That 169.87. Another person. That 169.87. Another person. That 169.87. We are waiting for another answer. Someone else kindly. Okay, let's assume that is the correct answer. There are present value of annuity is equals to annuity times present value interest factor annuity R percent power n. So here 1,000 times present value interest factor annuity 10% at period 4. 10% at period 4. So 1,000 times. So now let's go back to the tables. Let's go back to the tables. So thank you, Tambua. Back to the table. We are using the lower table now. We are using the lower table now because this is an annuity. Go to 10%, drop up to period 4. Go to 10%, drop up to period 4. 10% you up to period 4, we have 3.1699. Oh no, just give me the factor. 10% at period 4 in the lower table. So I'm saying 3.1699. 3.1699. So you can see we are getting the same thing. That 169.9. That 169.9. I want to believe you've all been able to read the table. Yeah. Okay, fine. Next, we look at present value of annuity due. That is next time. We'll pick from that point next time. Number 3, present value of annuity due. Present value of annuity due. I believe we'll be able to look at all the factors, then we proceed to something else. Now, as I said, this is very important. Make sure, and that is why I don't want to rush. I do not want to rush because this concept is very important. If you get it at this point, you will have no problem going forward. You'll be very much okay. So make sure you repeat these concepts, do the illustrations that you've done. In case of any question, you will ask. Any question for now? Any question before we close? Any comment before we close? Yes? Okay, fine. If no question, we are going to close at that point. See you on Saturday. See you on Saturday. And enjoy, or rather have a good night. Have a good night. Check whether starter class is to ensure we are recording. So now we have missed something. But no problem. So we are saying, so maybe just a recap. So we have said time value of money, it is that the fact that over time, the value of money changes. The value of money does not remain the same. And I'm saying, assuming here, now, that is year 0 today, and we have 10 years to come. 10 years to come. So we have 1 million shillings today here. Shillings 1 million. And here we have shillings 1 million. So we're saying the value of 1 million shillings today This, it's like, if you remember what I said, assuming someone tells you that I give you 1 million shillings today, or you wait, I give you 2 million shillings after 10 years. I either give you 1 million shillings today, or you can wait, I give you 2 million shillings after 10 years. Which one is better? And we said, holding other factors constant, because there are other factors that can influence your decision. Maybe you are going through a difficult time and you don't care what you're going to get after 10 years, but holding other factors constant, just look at the 1 million now and the 2 million after 10 years. You said you would rather go for the 1 million, because this it may be, if you determine what is the present value of 2 million shillings expected in future, because remember, this 1 million is in present value terms. This one is in present value. Present value means now. But this 2 million is in future value. This one is in future value. If an amount was be received in future, we say it is in future value form. If it's been received or paid today, we say it's in present value terms. So before you make your decision on whether to go for the 1 million or the 2 million, you're supposed to ascertain what is this 2 million in present value terms, because I'm being promised the 2 million in future value terms. But what is the present value of this 2 million in present value terms? That is, you bring it to present value terms. See, tumeanza kurecord. Oh, okay, yeah. So that was earlier. So what is this in present value terms? So when you ascertain the present value of these 2 million, that is bringing it in present value form, you may realize that it is 0.8 million. So if it is 0.8 million, you will say, I would rather go for the 1 million shillings today. Yeah, are we together? You would rather go for the 1 million shillings today, but you cannot compare 1 million and 2 million. Those two figures are not comparable, because one is in present value terms, the other one is in future value terms. You cannot compare an amount in present value terms with an amount in future value terms. If you want to have a fair comparison, or if you want to form an even ground for comparison, you must either take this 1 million to future value, or bring this 2 million to present value. And the most important thing, it is bringing, okay, either way can work. So, but you must compare the two amounts in same form, either in present value terms or in future value terms. And that is where now the concept of time value of money comes in, determining either the future value of an amount or the present value of an amount. Now, let's say something now about the time value of money. So time value of money, we've said here we have present value, and future value. So present value, we have that direction, and we have this direction. So this is to say, you can work from present value terms to future value, or you can work from future value to present value. When present value to future value, when we are doing present value to future value, we call it compounding. This one you must have done in mathematics, compounding. Compounding, it is determination of a future value from a present value. Determination of a future value from a present value. For example, in our example here, you have been given 1 million. You want to know, if I get this 1 million today, I'm going to invest. Remember, you're not just getting the 1 million and keeping it maybe under the bed. No. you'll get the 1 million and invest somewhere. If you invest, it will earn a return. So after 10 years, you will not just have 1 million, but you'll have 1 million plus a return. So we want to know this 1 million plus the return that you're going to earn, how much will it be after 10 years? That is determining the future value from a present value. And that is what we call in compounding. That is compounding. The other one, we are moving from future value to present. Like in this case, you're being given 2 million shillings after 10 years. But we want to know what is the worth? What is the worth of 2 million shillings 10 years to come? What is the present value of this amount? So you go backwards. Working from future value to present value, we call it discounting. Discounting. This is discounting. Discounting is determination of a present value from a future value. Determination of a present value from a future value. And I've said, when you are given an amount in present value terms and another amount in future value terms, and you are supposed to compare the two, you cannot compare when they are not in the same form. You are supposed either to convert them to present value or to future value and make a decision or make a conclusion. That is all about time value of money. So let's see what we have in the handout. There is a handout I've just shared. There is a handout I've just shared in the WhatsApp group. Kindly check. Kindly check. Have you seen that handout? I shared just a few minutes before the class. I want us to look at it. In case you have a question, you can ask before we proceed. In case you have a question, kindly ask. Okay, fine. Let's. I want to believe you've seen the handout. It's important to respond. Kindly respond if you've seen the handout. Okay, fine. Let's continue. Thank you, Alice and Akin, Alan as well. So up there, you can see the introduction, concepts of time value of money. Introduction. A shilling today is worth more than a shilling tomorrow. All what I've explained is what you can find there. Future value techniques. Future value techniques, you can see there we have future value. That is what I've explained. An amount that will be paid or received in future, we call it a future value. Then we have present value techniques. Present value, I've said, is an amount today. As an amount today, present value. Compounding techniques, but I'm not saying you are going to make sure you go through this, the theory part, at your own free time. But this is what I've just summarized. There is no need of repeating. I just want us to walk through. Compounding techniques. Compounding techniques, we've said, okay, this is what we did in mathematics. Simple interest and compound interest. So again, that is not important, so much important. I just want us to look at the, but let's, yeah, we are under compounding techniques. Here we've talked about two concepts, the concept of compounding, the concept of discounting. So I want us to start with compounding. That is compounding techniques. That's the reason why they are saying compounding techniques. Compounding techniques. So we start with the compounding techniques, number one. Determination of a future value from a present value. Compounding techniques. Compounding techniques. Now, we start with future value of a lump sum. Okay, in here, we will not focus too much on the illustrations that we have there in the handout. I want you to make short notes. I want you to make short notes as we continue. I have some handwritten notes here that I want to share with you. So just write concepts of compounding, or compounding techniques, and we start with the first one: future value of a lump sum. 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 Alan? Okay, I will share. But the handout is more summarized. So we start with future value of a lump sum. Now, when you talk about, the most important thing here to understand is what is a lump sum? What is a lump sum? A lump sum, this is an amount that is received or paid once. An amount that is received or paid once is what we call a lump sum. For example, let's say if you pay or receive 2 million shillings today, that is a lump sum. Or if you invest, let me show you. Let's first understand. We have two things here. We have a lump sum. We have a lump sum. And we have an annuity. And an annuity. So here, let's say we have periods. We have period 1, 2, 3, 4. So we have amounts. Let's start with lump sums. Lump sum amounts. Lump sum. Let's say in year 1, the amount is 300,000. In year 2, it's 550,000, 600,000, and 700,000. These are what we call, all these are lump sums. Okay, let's have annuities. Annuity amounts. These are like installments. They are equal: 400,000, 400,000, 400,000, 400,000. So annuities, they are equal amounts received or paid regularly. Equal amounts received or paid regularly. And we say, when we say regularly, we are saying it's either monthly, weekly, semi-annually, yearly, quarterly. That means like every month you're paying or receiving 400,000. That is an annuity. Or each year you're paying or receiving 400,000. That is an annuity. Equal amounts received or paid regularly. Lump sum amounts. Lump sum amounts, you're saying this is an amount which is received or paid once. They do not repeat themselves. For example, in year 1, you'll receive 300,000. In year 2, you're getting 550 or paying or 550. Year 3, 600. Year 4, 700. Maybe let's say year 5, 300,000. You cannot say that since 300,000 is appearing twice, that it is an annuity. No, it is not an annuity because it has not been received regularly. You've received 300,000 after some other cash flows have been received here. Are we together? So all these are lump sums. All these are lump sums. However, if, for example, if you get 300,000 here and 300,000 here, we have two 300,000s that follow each other, this one and this one. This one will be referred to as an annuity. This is an annuity. Year 1 and year 2, or period 1 and period 2, we have an annuity of 300,000. because they follow each other. Yeah. But if the 300,000 occurs after, let's say, for example, here we have 700,000 and here we have 300,000. So in year 1 and year 3, we have 300,000. These are not annuities, they are lump sums, because in between them, there is a figure that is different from them. I want to believe that is very clear. That is clear. A lump sum and an annuity. This is a concept that we are going to use a lot in financial management, and that is why I want you to be able to differentiate lump sums and annuities. Again, so this was 6. Let's say this was what? This was 500. Let's say now, yeah, 300,000 there. 300, yeah, let's say 300,000 here. So in year 4 and year 5, the 300,000 becomes an annuity because they follow each other. We have two 300,000s that follow one another. So they are annuities. So I want to believe that is clear. That's okay? Okay, fine, let's proceed. So we now looking at future value of a lump sum, future value of this kind of cash flows, future value of this kind of cash flows. So when you want to determine the future value of a lump sum, future value of a lump sum, future FV, its future value of a lump sum is equals to present value, or let's say principal, what you are used to, principal times 1 plus R power n. Principal times 1 plus R power n. And this is what you call present value. Present value. This principal figure here is what we call present value. Let's see what we have in the handout there. Check what we have there. Where are we? Where are we? Future value of a future value of a lump sum should be there. If you look at the handout, you'll see using tables to find future. No. Equation for finding future values of a single amount is derived as follows. How it is derived is not so much important to us. The most important thing is this. Yeah, this is how we get the future value of a lump sum. Future value of a lump sum is equals to principal into brackets present value times 1 plus R power n. This factor here, this factor 1 plus R power n is called what? Future value is called future value interest factor. This one is called future value interest factor. Future value interest factor. That factor is called future value interest factor. This one is very important. 1 plus R into bracket power n. So here we can say where FV is future value, R is the discounting, or not discounting rate, but rate of return. It's important for you to write this formula. Just write this, just write that. Rate of return is like the interest rate. Rate of return is like the interest rate. Yeah. Do we have an example there? So the example, yeah, there should be an example somewhere. Yeah, there is an example there. Look at that example. They're saying, assume that you've just invested Kenya shillings 100,000. The investment is expected to earn interest at a rate of 20% compounded annually Determine the future value of the investment after 3 years. So, okay. Let's look at that. We are doing that illustration, that example. We're saying, assume that you have invested shillings 100,000. That is the present value. That is the principal. The principal amount, which is present value amount, is Kenya shillings 100,000. 100,000. Then the investment is expected to earn interest at the rate of R is 20% per annum. This per annum is very important. Okay, it is not given. They have not said per annum, but we say when you get a rate of return where the period, whether the per annum, per month, semi-annually is not stated, the standard measure is per annum. So unless it is specified like semi-annually or what, you should take it as per annum rate. So per annum is 20%, compounded annual. Determine the future value of the investment after 3 years. N, we should have said N here, N. N is equals to number of periods. Number of periods. Kindly have that. Number of periods. Number of periods. Make sure you write that. So here, our period is 3 years. We are investing for 3 years. So future value we are saying is equals to present value 1 plus R power N. So future value is equals to 100,000 times 1 plus 0.2 power 3. Power 3. So get the value of the investment after 3 years. Value of the investment after 3 years is how much are you getting? There are people, no, but you must be knowing how to put this power 3 in calculators. Anyone who doesn't know, you will be assisted. Now, for example, we have two answers here. We have 172,800 and we have 106,120. Alice, I'm doubting your answer. At a rate of 20%, even in the first year, we are going to earn 20,000. Because first year one, we will say 20% times this. Times 100,000. That is 20. That means it's more than 106,000. So 178, probably 172,800. 172,800. Alice, repeat your calculation. Okay, yeah, 172,800. That is what you're supposed to do. Another method of getting this. Another method of getting this is or. So here you say or a very long method. You'll say period here. Period 1, 2, and 3. Amount. Let's say 100,000. No, will that give us? No. No, that is the only way. Okay. The other method is where we say, but this one is very long. Where you say here it's 1 plus 0.2. The figure that you'll get here, you bring it here. Then you continue. But that will not apply in this case because we are only investing 1. So you can continue. You grow by that rate. So just stick to this. Just stick to this. Any question before we continue? We want to proceed. Okay, number 2, future value of an annuity. Future value of an annuity. Future value of an annuity. Future value of an annuity, and you have seen how we get the future. I've explained what's an annuity. Future value of annuity. Future value of annuity. Now, a future value of an annuity, just like we've said, you get the annuity. It's an annuity when the amount occurs repetitively, but regularly. So future value of an annuity is computed as follows. Without wasting a lot of time, future value of annuity is equals to the annuity. You get the annuity amount times annuity amount times. So we have the future value annuity factor. The future value annuity factor, you say 1 plus R power n minus 1 over R. That's how we get the future value of an annuity. 1 plus R, and write these formulas because the way they are in the handout. Okay, they are very much simplified in the handout. Just write what I'm writing on the board. Yeah, it's there, but write. Future value of an annuity is equals to annuity times 1 plus R into brackets power n minus 1 over R. This factor here, the factor 1 plus R power n minus 1 over R is called future value interest factor of an annuity. Future value interest factor of an annuity. What have they said there? Future value interest factor of an annuity. Future value interest factor of an annuity. This one. Now, we have tables. We have tables where these factors can be read from. Like, you remember what table do we have? We have math table. Do you people know what's a math table? Or maybe what we call what? Normal curve, normal distribution curve. We have tables. We have tables where you can read these factors. When we go to discounting, I'm going to share the tables so that we can see. But for future values, the tables for compounding, it's not widely used in financial management. So just get these formulas right. Yeah. So any question here? There is nothing to explain. We know R is the rate of return or the interest rate. N, it's the number of periods. So there is nothing to explain. Let's go to what? Let's have an illustration. Do we have an illustration there? From the above example, there is a statement that says we have an example. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest of 12%? Are you there? Have you seen that example? And finding future value of an annuity. Oh, that's due. Sorry. What is the value of 100,000 investment annually at the beginning? That's an annuity due. We are coming to that. I want us to have an illustration on the illustration on future value of an annuity. Okay, let's say from the above example, there is a part that is missing here. There is a part that is missing, but all in all, let's just write an example there. Just write something. Just write an example, an illustration. Say an investor intends to invest. An investor intends to invest shilling 60,000 at the end of each year for 4 years. An investor intends to invest shilling 60,000 at the end of each year for 4 years. At the end of each year for 4 years. Full stop and say, the investment will earn interest. The investment will earn interest at a rate of 20%. The investment will earn interest at a rate of 20%, compounded annually. The investment will earn interest at a rate of 20%, compounded annually. Compounded annually. Full stop. Determine the future value. Determine the future value of the investment. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. After 4 years. Now, future value of the investment. Now we start. This is how you should be approaching these questions. You first analyze the question. For example, here we are saying amount to invest is 60,000 at the end of each year. So annuity. We say annuity. Shillings 60,000. Annuity shilling 60,000 at the end of each year for 4 years. Period is 4 years. 4 years. Then the investment will earn interest at a rate of 20%. So 20% per annum. So we want the value of the investment after 4 years. So future value of annuity is equals to the annuity times 1 plus r power n minus 1 over r. So here you say 60,000 times 1 plus 0.2 power 4 power 4 minus 1 over 0.2. So get the value of the investment after 4 years. Then I show you another way of doing it. Get the answer, get the answer. Get the answer. $322,080. $322,080. Another person. 322,080. Another person. Alice, okay, that's fine. Now, there is another way of doing this question. So this is now, you say period, 1, 2, 3, 4. Annuity or amount. Remember, this person is investing 60,000 at the end. Yeah, at the end of each period. 16. 16. 16. 16. At the end of each period, this person is investing 60. So here you say 1 plus R power N. If we want to treat each amount as a lump sum, then here we will have future value. Future value. So here we will have 1 plus R. 1 plus R. This is 0.2. 0.2. 1 plus 0.2. 1 plus 0.2. 1 plus 0.2. 0.2. 1 plus 0.2. So before that, we know we've not put N. That is what I want to illustrate here. That is what I want to illustrate here. So we are 0. We always start at 0. 0 means now 1, 2, 3, 4. We are talking about 4 years, which is 1, 2, 3, 4. So here we have at the end. We are investing at the end. So at the end of the first year, 0, 60, 60, 60, 60. I want us to put N. So this 60 that you've invested at the end of year 1, how many times will it earn interest? The 60 that you invested at the end of year 1, how many times will it have earned interest at the end of year 4? It is here. 1, 2, 3. We have invested 60 here, so it will earn a return here, a return here, and a return here. So you say power 3. That is power 3. Then the other 60 at the end of year 2 here, it will earn interest here and here. So you say power 2. The 60 that you invest at the end of year 3, it will earn interest once. So you say power 1. And the last one, the 60 that you are investing at the end of year 4, it will have earned no return. So you say power 0. So multiply and get the total. If you multiply and get the total, we should be getting the same answer as this. We should be getting the same answer as this. So the reason why I just want you to get the concept, the concept here of power what, power what, power what.
growth rate, 5% administration of heights, 80,000, and basically that amount is because you can see it's not be given per unit, that automatically is a fixed cost, a growth rate 5%, variable selling and distribution cost per unit 30, which basically give us what? And actually the growth rate is 10%, fixed selling and distribution 60,000, growth rate is 5%. So what we are required to do here is we prepare the forecasted statement of profit or loss given the current projections. Roman 2, we are required to determine the break-even levels in units and also revenue for the next 5 years. And number C, we are producing a graph, present the summary of revenue, profit, break-even, revenue for each of the next 5 years. So these are very, very simple question. It's a very good question here. We are going to start with part A. Part A of the question, whereby we are required to do what? We are required to do what? We are required to prepare the forecasted profit statement given those particular projections. So this will be our solution here. Will be our solution. And we are going to start with part A. Part A of the question, what are we required to do here? We're required to prepare the forecasted statement of profit or loss. So basically, what you're told, there is some information which you're given here that Delaware Limited would like to evaluate its performance for the next 5 years. So basically, we are going to prepare this projected statement of profit or loss for the next 5 years from 2023, and basically that is the next 5 years from 2023. So we will start with the year 2023 here, 2024, and basically we're going to have up to which year? I think that one should be up to 2028. That's the position. Yes, because we have 1, 2, 3, 4, 5. Yes, it should be up to 2027. 5 years. 5 years. That's basically what we have. Now, how do we prepare this forecasted statement of profit or loss? So basically, to prepare the forecasted statement of profit or loss, we need first of all to compute the sales of the company. We will then proceed with less the production cost. We get basically what we get the gross profit, and then we less the other expenses. The other expenses or the other costs which are not necessarily production cost. Now, for us to be able to do that, we need to have all these variables, because you can see we are only given the variables for the first year. So we need to compute those variables for the next 5 years. So let's me copy this and have that on the other side here. I'll copy of those variables, and equally I'll copy for the first year here. That is the variables which are given for 2023. Yes. And then what we are given here is the growth rate. And basically, we're told that the following details relate to the main product lotus and the estimated changes in price and cost per annum. So whatever you're given here, these are the changes per annum. These are the growth rate per annum. So what we need to do, basically, we need to compute these the values for the next 4 years here. So the growth rate for these for the annual demand, this one we are told will be 10%. So this in 2024, the average annual demand in 2024, this one will be equal to 110% of this one. In other terms, this one will be equal to 1.1, which is the same with 110% times what? Times this. That's her. So we do the same for this other item here. That is the selling price per unit. This one will grow with 5%. So this one will be equal to 105% of the selling price of 2023. So this one is basically the same with what? Is the same with 1.05. 1.0 what? 1.05. 1.0 what? 1.05. So basically, let's do that. We take 1.05 times this one. Then direct material, this one will increase with what? 10%. So therefore, this one will be 1.1 times this value here. And remember what we are doing here, we are basically developing a formula. So this formula which we will develop here, we are going to apply that for the next 3 years. That's yes. Then the direct material here, this one will also grow with 10%. So basically, instead of doing that manually, we can be able to apply the formula we have up here. This formula will apply for direct labor because it will also grow with 5%, and also the variable production of heights. That's yes. So this is 110% of this, is 110% of this. That's yes. What about this one? this one will grow with 5%. So this one will be equal to 1.05 times this one. Yes, and basically this administration of it, also this one will grow with 5%. I can also apply that formula down here for this other item. That one is 105% of this. So this one will grow with 10%. So this one will be equal to 1.1 times what I have here. I enter. And finally, this one will grow with 5%. So this one will be equal to 1.05 times what I have here. I enter. Sasa, yes. So then what I'll do, this particular formula which I've developed for 2024, it will basically apply for the next 3 years. I'll just apply that formula there, and I'll be able to have the values for the next 3 years like that. Sasa, yes. So basically, we say that you can be able to confirm, for example, how we are computing each of the values here. So maybe what I need to do, let me do away with this decimal. I think we have decimals. Do we work with the decimals? Yes, let's work with our figures to 2 decimal places here. To 2 decimal places. 2 decimal places like that. 2 decimal places like that. Let me expand these columns here. Yes. So basically we said, yeah, you can be able to confirm how all these values have been computed. For example, if you want to know how this figure has been computed, you just highlight that cell and then you come up here. So a formula is not appearing up there. Why is the formula not appearing? Our formula, remember, our formula should appear up somewhere up here. I don't know why our formula is not appearing there. Okay. But the formula basically should appear up here. I don't know why it is not appearing. Yes, but basically our formula should appear up there. Yes. So, but basically if you check here, for example, this one is like 110% of this. 110% of that. I don't know why our formula is not appearing up there. Let me first of all close this and then I reopen afresh. I close this and then I reopen. Yes, I think now we should be able to have our formulas up here. So we said if, for example, yes, our formula is now appearing up there. If you want to know how any of the figure here has been computed, you just highlight that cell and you'll be able to see the formula up there. For example, this value here, you can see it's 110% of that, which is basically very much correct. So therefore, basically all these particular variables here, or we have been able to come up with these particular variables using the figures for the base period 2023 and the growth rate. Now, having these 10, what do we need to do? We need to compute the profit or loss. How do we compute this profit or loss? We can come up with a formula here. To compute the profit or basically loss, we first of all compute the sales. We first of all compute the sales of the company, then we minus the cost of production. The cost of production. So this is basically the production cost. This is the production cost. The production cost. We will get the gross profit, and then from there we move, and basically we less the other expenses. The other expenses, these are the non-production costs. The non-production costs which are incurred by what? By the company, or basically the other costs which are incurred by this company, which are not necessarily production what? Production cost. Production what? Costs. Sasa? Yes. So that's basically how we compute the profit or loss. So therefore, what we need to do first of all is we compute the sales. How do we compute the sales? This one is computed by taking the quantity produced and sold times the selling price per unit. The selling price per what? Per unit. So that's basically how we are going to compute this. So for 2023, I will take this one, the annual demand. Annual demand, remember the number of units to be produced and sold, this one. I'll multiply that with the selling price per unit. The selling price per unit is this one, like that. Then I'll basically do the same here, just like what you have done up here. I will basically develop the formulas for computing these variables for the year 2023, and then I'll apply that formula for the next 4 years. So that will make our work very easy here. So to these sales, we need to proceed and we less. We need to proceed and we less the production cost. The production cost. Now, this production cost will comprise of what? This one will comprise of direct material cost, direct labor cost, variable production of heights, and then the fixed production of heights. These are production costs. But if you check on administration, these are not production costs. The variable selling and the distribution are not production costs, and the fixed selling and distribution still not production what? A cost. Let me first of all, I list this particular production cost, but I need to do some editing as far as this is concerned. This one should not be per unit. Direct labor will not be per unit. Will not be per unit. The variable production of heights will not be per unit. Yes, so that basically what we need to have there. So I will start by computing direct material cost. Direct material cost, this one is equal to direct material cost per unit, this one, times the unit produced and sold. And I hope you can be able to recall we said at a CVP, we assume the units produced are RR, the units produced are equal to the units sold. We don't have cruising stock here. So I will multiply that with the units produced, this one. For the labor cost, I will do the same. Labor cost per unit, this one, times the number of units produced and sold, 50,000. Then variable production of heights, I will take the variable production cost per unit, this one, times the number of units produced and sold, this one. Then for fixed production of heights, this one does not depend with the number of units produced. This one, we take that amount there. Yes. Sasa, yes. So then from there, what we need to do is basically we get the gross profit. We will get the gross profit. The gross profit. How do we get the gross profit? The gross profit will be equal to the sales, this one, minus the production cost, minus this, minus this, minus this one, minus this one. So the sales minus the production cost. We get what? We get the gross profit there. So once we get that gross profit, we need to proceed and we less the other costs of this company. We need to less the other cost, and basically I've said that these other costs are the non-production costs. Other costs. Other what? Other costs. So the other costs, basically, these are the other costs of this company, which are not necessarily a production cost. So I think I will pick these 3 costs here. I copy them. I bring them down here. Yes, I will start with the administration of height. And administration of height, I say that this one take into account, we are given a figure. This is a fixed cost. This one will not have to be based on the number of units produced and sold. Variable, selling and distribution, this one will not be per unit, but basically this one has to be computed. This one will be equal to the variable selling and distribution cost per unit, this one, times the number of units produced and sold, these ones, 50. Then the fixed selling and distribution is what we have here. That one is equally not per unit. Yes. So I think having that now, we can basically proceed and we compute what? We compute the profit, the profit for the year. The profit for the year. The profit for the year, of which now the profit for the year, this one will be the gross profit minus the gross profit minus the other costs. Minus the other what? Minus the other costs. So this one will be equal to This one will be equal to the gross profit, this one, minus these three costs, minus this, minus this, minus that one. We get what? We get the gross what? We get the gross profit. And I think having this now, we are done. We are done because we have developed a formula here. So what we just need to do is we apply that formula for the next word 4 years here. We just apply that formula for the next word 4 years like that. Just like that. Yes. So maybe we just need to expand our columns here. Yes. So basically that's what you have, and maybe you can underline what need to be underlined here. We can underline this. We can equally underline those two values here, like that. Yes. So basically in our case, we have the profit for what? The profit for the year there. And basically this is it, that what is required as far as part A of that particular question is what is concerned. That is what was required there. You can see that one is quite simple. Quite simple. Quite what? Simple. Variable selling and distribution. Variable selling and distribution. Variable selling and distribution. Variable selling and distribution. This one rules. We have said this one has to be. I hope you can see up here. This one is per unit. So that's why we have taken this particular amount. I hope you can see how we have computed that. We have taken this times the number of units produced and sold, times the number of units produced and sold, this one. That's why we got, I think, a figure of 1.5. This times that. That the variable selling and distribution cost per unit times the number of units produced and sold. Yes. So in our case, basically we are done with that. And we said the advantage with Excel is to make our work easier. You can see we just need to come up with a formula for computing those figures for the first year. Once we are done with that, we just need to apply that formula for the next 4 years. So which basically becomes quite what? Simple. So let's move to the other part of the question. We copy this. We copy this, and basically we have it down here. Yes, so what you're required to do here is we compute the break-even levels in units, the break-even in revenue for each of the next 5 years. In other terms, what you're required to compute here are two things: the break-even point in units, the break-even point in what? In shillings. I hope you can be able to recall what we said yesterday, how we compute the two. How do we compute the break-even point in units? This is basically how we compute the same. We take the fixed cost divided that with the contribution margin. Yes. For the break-even point in revenue, or basically in shillings, we compute that by taking the fixed cost divided that with something called, okay, yes, there we just use the same formula up here, but whatever we get, we can multiply that with the selling price per unit. Yes. So we need to have some items here. Number one, we need to have the fixed cost of this company. We need to have the fixed cost. The fixed what? The fixed cost of this company. Now, the fixed cost, basically this comprises of the fixed production cost and the other fixed cost, or the total cost. We don't, here we consider all the fixed costs, not necessarily the production fixed cost, but all the fixed costs, all the fixed what? Cost. Now, this company has got a number of fixed costs from what we have up here. So number one, we have this fixed production of height. That is basically the fixed cost. And then do we have any other fixed cost? Yes. We also have this, the fixed administration of height. And then we also have this fixed selling and distribution, this one. Yes, we consider all the fixed costs, all the fixed what? Costs. That will basically give us 240,000. Then, having said, we also need to proceed and we compute something called the contribution margin. The contribution margin. The contribution margin per unit. The contribution margin per unit. How do we compute the contribution margin per unit? The contribution margin per unit, this one is equal to selling price per unit, represented by small p, minus the variable cost per unit. The variable cost per unit. And equally here, when considering the variable cost, we consider all the variable cost of the company. We consider all the variable cost of what? All the variable cost of the company, all the variable cost of the company, or the variable cost of the company, or the variable cost of the company. Aziz is asking about administration of it. Yes, basically I've said, if you check on the data which you have here, you can be able to tell which costs are fixed. Any cost which is not given per unit is fixed. This one is fixed because you can see it's not per unit. This one is also fixed, it's not given per unit. This one is also fixed. That's why I've said we have 3 fixed costs. This one, and this one. These are fixed costs. The 3 are fixed costs. They are fixed costs because they are not given per unit. If they are per unit, then they should be variable. Now, let's move and we compute the contribution margin. And basically, contribution margin, I've said we take the selling price per unit. So the selling price per unit, we have it here, this one, 500, minus all the variable costs. The variable cost, we have direct material. I'll take 500 minus direct material, which is a variable cost, minus direct labor, minus variable production of height, minus the variable selling and distribution, that one. So I've taken the selling price per unit minus 4 variable cost per unit there. I'll get what? I'll get the contribution margin per unit. This contribution margin per unit, how is that computed? I hope you can see the computation of that. This one minus the 4 what? Variable costs. Yes. So basically having that then, I can proceed and I compute now the break-even point in units. Break-even point in units. So how do I compute the break-even point in units? I'll basically apply this formula. I'll take the fixed cost, divided that with the contribution margin per unit. The contribution margin per unit. And basically that is what we have up there. So I'll take the fixed cost, this one, divided by this one there. That will give us the number of units to be produced and sold for the company to break even. And I think we can also have a value there for 2 decimal places like that. The next, I also need to compute the break-even point in shillings. The break-even point in shillings. The break-even point in what? In shillings. So to determine the break-even point in shillings, we just take whatever you have up here. That is the break-even point in units. Break-even point in units. I multiply that with the selling price per unit. The selling price per what? Per unit. So I'll take whatever I have here times the selling price per unit. The selling price per unit, I have it up here, this one. So that will basically give us the break-even point in what? The break-even point in what? In revenue, or basically in shillings. So having that now, for the first year 2023, I just need to apply that formula for the next 4 years. For the next 4 years like that. Yes. So basically that is the break-even point in units, the break-even point in what? In shillings. In what? In shillings. We are done with that. So we move to the last part here. We move to the last part. Let's copy this. In case of any question, please type it in the chat box. I'll be able to see it. So here we are told using suitable graphs. Using suitable graphs, summarize, that is suitable graphs. Summarize the revenues, the profit, the break-even revenue for each of the next 5 years. So I think in this case, what you're required to do here is to come up with a dashboard. A dashboard is basically a summary of the key financial metrics and also accompanied with data visualization tools. Yes, so basically I think what we need to do here, let's have our years 2023, 2024, all the way to 2027. Yes, so I think maybe first of all, we can have a summary of the revenue. I think we can present this, all the values separately. So the revenue will start with the revenue for 2023, which is this one. I'll basically enter and then basically apply that. All the values we have up here, all these revenues are the figures which we have down here. Yes. And I think in that case, we can first of all present this, the revenue separately in a graph. We said once you have that, we just need to highlight the entire data there like that. And then we come up here, we say insert. We come to the recommended charts here. You'll be given some recommendations here. Some recommendations like that. Maybe you can pick any of these. For example, you can pick that, but you can see there is some space which is left here. That space is because of whatever you have here. Whatever you have, this particular empty what? These empty columns here. That's why we have some space. Though no problem with that. Let me see here. So we insert. Yes, you can see that space is disappearing. You can see that space is disappearing. Yes. So basically, this is a graph which shows the projected revenue of this company for the next what? For the next 5 years. For the next what? 5 years. For the next what? 5 years. So I think we are done. See, you'll be able to do that for the other two variables, because you just need to do the same for profits. For profits, so you'll have the profit for the 5 years and also the break-even point in revenue. So you'll be in a position to do that. Mary, Sharon. Yes. Let me give that as an assignment. Let me give that as an assignment. Yes. So you finish on that, and then so that we move now to the other question. So you can see this question was a simple one, a simple one, because that is a question which you could have done within very few minutes. You're done and you get all the marks. Yes, it was a simple question. So that is basically what was required there. There is now this other question, which was the last sitting. Last sitting. Yes, we have it here. I hope you can see this question here. The question I'm presenting, this one is for August of 2025. If you can see the question for August 2025, please confirm. Please confirm. Can you see this question for August 2025? Or you can only see the other question which we... Okay, sawa. Can we take a short break before we come back and look on this? We take a short break of just like 5 minutes. I want us to finish on time today. I release you a little bit earlier. We take a short break, small breather of small breather. Or we just continue? Okay, so we take a small breather of 5 minutes. Then we come back, we look on this. So a small break, we come back. Yes, are you back? Are you back? Can we continue? Can we proceed? Can we proceed? Can we proceed? Can we proceed? Yes. So let's continue so that we finish on this question. So we are told you are the management accountant of Maras Tech Limited, a company that produces two types of product, alpha and beta. Alpha and beta. So we are told the company want to understand the cost structure, the profitability for both a product as well as the break-even point based on the following data for the month of July 2025. So we are given data about the two companies, about two products, not companies, about two products. Basically, we have two products, alpha and beta. So what we have is the selling price per unit, the variable cost per unit, the fixed costs, and the unit sold. So what are we required to do? Part A, I think we got through to part A of our question here. Part A, basically we are required to do what? We are required to prepare the contribution margin statement and the profit, net profit for each of what? For each of the products. So we basically copy that. We paste it here on the other side. Yes, so we are required to prepare the contribution. So this is basically the contribution. This is the contribution margin statement and the profit what? And the profit statement. So remember here we have two products, unlike the other question which we had, which were preparing the profit statement basically for a number of years. So here we are preparing the profit statement for 1 year, but basically for two products. So we need to copy this, our two products, and basically we have that here, the two products, product alpha, and basically product what? Beta. Now what we are required to do here is we prepare a contribution, a contribution margin statement and the net profit statement. So basically what that means, we need to show the contribution for each of the product, and that is the total contribution and the profit. So how do we compute the contribution? Contribution is equal to the sales minus the variable costs. And then the net profit is equal to the contribution minus the fixed cost. Because I hope you can see in this question, we just have two costs. We just have two costs, the variable cost and the fixed cost. So to get the contribution for each of the product, we will take the sales minus the variable cost. And then to get the net profit, we take the contribution minus the fixed cost. So what do we start with here? We start by computing the sales. We start by computing the sales. Yes, let's have all these variables here first of all, before we proceed to do that. Maybe we need to use some of those variables down. Maybe in answering the other part of the question, we need to have these variables here. These variables here. Yes, and basically we have the other variables for the other product. Yes, So we don't have to copy for the other product. By default, Excel will be able to pick for us those values. So we need to start by computing the sales. So this paper for last sitting is basically, it was a very simple paper. It was a very good paper. You can see the kind of questions. I think we have done a number of questions, but it was a very good paper. It was a very good paper. Let's hope the paper for this time will also be as simple as this paper for last sitting. So to compute the sales, basically for each product, I will take the selling price per unit times the number of units produced and sold, these ones. As simple as that. Then I basically need to less the variable cost so that I get the contribution. I need to less the variable cost, the variable cost. So the variable cost, this one will also be straightforward. We will take the variable cost per unit, this one, times the number of units produced and sold, this one. And then I'll get what? I'll get the contribution. I'll get the contribution. The contribution. So the contribution here, this one will be equal to the sales minus the variable cost. Sales minus the variable cost, that one. And then I need to proceed and I get the net profit. To get the net profit, I'll take that contribution, I less the fixed costs. I less the fixed costs. I less the fixed what? The fixed cost. So the fixed cost is basically what we have here. So meaning that the net profit, this one will be equal to what? This one will be equal to the contribution minus the fixed costs, like that. Like that. Yes. So basically, I think I can bold this one before I apply that formula for the other product. Let me bold that one. I can also shade it. Yes. So basically, what I need to do, I apply this formula for the other product like that. For the other product like that. I think I can introduce a comma here. Okay, so I think that is it. Okay, I don't know what is happening this value for 200. Okay, let me do away this particular comma here. Same case there. Okay, so let's retype these figures manually. I don't know what is the problem with those figures. 200,000. And these other ones should be 200,000, 300,000. Yes, I think now they should be okay. Yes, so that should be okay now. That should be okay. Yes, alternatively, we can use that. Formula as is. We compute the contribution margin per unit times. Yes, but I think either of the approach should give us the correct answer. Either of the approach should give us the correct answer there. Yes, so I think basically that's what we have. Yes, so what you have computed is the contribution. You have also computed what? The net profit. So basically it was simple as that. So we move to part B. We move to part B. So in part B, basically what are we required to do? We are required to calculate the break-even point in units and revenue for both products. For both what? For both products. Basically here, we are not required to compute the break-even point for the company, because if we are required to compute the contribution, if we are required to compute the break-even point for this company, we need now to introduce the aspect of the wage. So, but here we are required to compute the contribution, the break-even point for each product, for each what? A product. So, which basically becomes quite simple here. So that will be part B of the question. So this is the break-even point. The break-even point in units, and basically the break-even point in units and also in revenue. Yes, so how do we compute this? We just need to remember the formula. To compute the break-even point in units, we take the fixed cost divided by contribution margin. I think what is missing here is just the contribution margin. Let's just compute that one. Contribution margin per unit. Contribution margin per what? Per unit, which will be equal to the selling price per unit minus the variable cost. So for each product, so this one will be equal to the selling price, this one, minus the variable cost, this one, which is how much? Which basically will give us 400. Yes, which will give us 400 like that. And I hope these units are okay. So I think we have a problem with these particular values here. I think the person was typing them, introduced a comma, that's why you can see. They are not aligning on the left, like the other values. Because they should be aligning on the left. Okay, so I think it's okay then. So then, okay, we have now the contribution margin. So having the contribution margin, we can proceed and we compute the break-even point in units. So the break-even point in units, we just need to apply our formula here, which will be equal to the fixed cost. The fixed cost divided by contribution margin, and which should be per unit. Which should be per unit. So this one will be equal to the fixed cost, which we have up here, divided by the contribution margin, this one, and that will give us 500 units. Then we compute the break-even point in revenue, or basically the break-even point in shillings. And you have said that this one will be equal to the fixed cost, or in other terms, the break-even point in units, and then we multiply that with what? We multiply that with the selling price per unit. As simple as that. So therefore, this one will be equal to the break-even point in units, this one, times the selling price per unit, this one. Yes, so that basically will give us the what? 350. Having that, then we need to apply that for the other product like that. So in that case, we have computed the break-even point in units and basically for revenue for both products, that is product alpha and the product what? Beta. Product beta. Quite simple. Quite simple. Yes. So we move to the other part here. That is basically part C of the question. Part C of the question. So what you're required to do here is to compute the margin of safety. So provided you remembered the formula here, this was a simple question here. Yes. So margin of safety in units and as a percentage. Now, how do we compute the margin of safety? Margin of safety basically is the difference between the current sales, what the company is producing and selling, and the break-even point. And the break-even what? Point. So therefore, to compute the margin of safety, we take the current sales, and actually we are taking the current sales in units because we are required to compute the margin of safety in units, the current sales in what? In units, in units, minus the break-even point in units. The break-even point in what? In units. The break-even point in units. Then to compute the margin of safety as a percentage, margin of safety as a percentage, we do the same basically. We will take the current sales. Maybe I can just use, let's have the opening bracket here. The current sales basically in units minus the break-even point also in units. We get the difference and then we divide that with the current sales equally in units, and then by the end of the day, we multiply that with 100. We multiply that with what? With 100. That will give us a margin of safety as a percentage. So let's start by computing the margin of safety in units. So this one will be equal to the current sales. How many units is the company currently selling? So the unit being currently sold 1,500 minus the break-even point in units. Break-even point in units is this. And what does this mean? This basically means that if the current sales, if the number of units being sold, currently sold by the company reduces with 1,000, the company will obviously start making losses. That's what we mean by that. So then the break-even, the margin of safety, that is, as a percentage, we will basically take this difference because this is now the difference between current sales and the break-even point in units. We divide that with the current sales, this one, which is 15, and then we multiply that with 100. We multiply that with 100. We multiply that with what? With 100. We have taken the difference between current sales in units and the break-even point, which is what we have here, and then divided that with the current sales in units, 1,500 times 100. So that will give us this one as what? As a percentage. Okay, so I think we can do this. Let's do this. Let's do away with this particular 100. And then whatever you get, we basically introduce what? Introduce a percentage here. Yes, and equally we can give our answer to the nearest whole number like that. So then we basically apply that for the other products there. For the other product. So what you have computed here is the margin of safety in units and the margin of safety in what? As a percentage. As what? As a percentage. As a percentage. Yes. Quite simple. So let's move to part B. To part D. Part D, we are required to carry out sensitivity analysis. I hope you know what is sensitivity analysis. Sensitivity analysis basically we try to change our original variables and we see how that will impact on the profit, how will that maybe will impact on the break-even point of this product or maybe the profit of this company. What are we told in part D? We are told to perform sensitivity analysis by calculating how a 10% variable change in all inputs, in all product data, that is, in all product data, other than the fixed costs, for both products affect the contribution and the break-even point. So in other terms, what we require to do here is that we vary, we change all the inputs except the fixed costs. And in that case, we are assuming all the inputs are changing, or basically we assume a 10% variable change. Variable what? Change for all inputs except the fixed what? Cost. And we see how that will affect how that will affect what? How that will affect the contribution margin and the break-even point. Sasa? Yes. So let's copy this. We have it here. Yes, I think this was a very, very good question. A very, very good question here. Yes, so basically we need to have equally our products, our two products down here. Maybe we can just recopy them afresh. Yes, so we have our two products. So remember, we have now the inputs which you're using here. Basically, we have this input, 4 of them. We just copy all of them. So we need to have our inputs here. And basically, we are required to change all these inputs, except what? Except the fixed cost. And we assume that all the inputs are, or we have a 10% variable change. 10% variable change. I hope you know what is 10% variable change. In case of things like the selling price, things like the number of units to be sold, because this result to sales, these two variables we are going to assume they will increase with 10%. But for the costs, we assume or basically a 5% variable change for the costs they reduce. Sales, the selling price, units sold, a 10% variable change. Those two variables do what? Increases. Will do what? We increase. So therefore, the selling price here for these two products will increase with 10%. So the selling price, this one will increase with 10%. We take this one and basically we increase it with 10%. To increase that with 10%, we just need to multiply that with 1 times 1. So that will come to 770. For the other product, we just apply that formula. And that one will go to 990. That is 10% variable change. Now, for the variable cost, if 10% variable change, we assume that this one reduces by 10%. Reduces by 10 what? 10%. Reduces by 10%. Now, as this check what you are told here, we are told to assume a 10% variable change. That I think that basically what we need to 10% variable change. 10% variable change means what to the selling price? %10 variable favorable change. The selling price will reduce. Understand. But favorable. Favorable means what? Favorable. Remember the other question which we did. There was adverse. So that's why I think we are reducing the selling price. Sasa is here a 10% favorable change means that if it is sales, the sales increases. So anything which is used in the computation of sales, we are going to increase it with 10%. including the selling price per unit, including the number of units to be sold. But now for the cost, a 10% variable favorable change for cost, we assume they will reduce. Do we agree on that? Do we agree on that? Yes. Selling price automatically here will increase. Selling price will increase. The other variable we are going to increase is the number of units to be produced and sold. But for the cost, a 10% variable favorable change is a decrease as far as the costs are concerned. That's yes. I think you have agreed on that. So therefore, the variable cost, this will reduce because it's a cost. So this one will reduce by 10%. It will be 0.9 times 0.9 times what we have here, this one. So that reduces to 270. And basically, we do the same for the other product, which is beta. It reduces from 500 to 450. Now, the fixed cost, we are told that this one we assume it will not change. The fixed cost remain the same. The fixed cost remain the same. Remain the same. So the unit sold, this one, because it is used in computing the sales, a 10% favorable change, we assume that this one will also increase with 10%. This will be 1.1 times